successors to Powell. Ira Jersey is chief U.S. rate interest strategist at Bloomberg Intelligence.
I think anyone who in that ilk who has been a member of the Federal Open Market Committee or is a well-respected monetary economist, I think would give the market at least a little bit of comfort. But you're still going to see, if Jay Powell is removed, you still will see a pretty big steepening of the yield curve, I think, and higher yields in the long end.
Ira Jersey of Bloomberg Intelligence. So bottom line here, recapping, resetting, stocks lower, short-dated bonds climbing after a White House official told Bloomberg that President Trump is likely to fire Fed Chair Jay Powell. But at the news conference, Powell, the president, saying he is, quote, not planning on doing anything to remove Jay Powell. Again, S&P 500 index down by 0.1%. Briefly, coming up, 2:30 p.m. Wall Street time, we have got an interview with the CEO of Bank of America, Brian Moynihan. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back, we go to Washington. And once again, your host, here she is, Kayleigh Lyons.
All right, Charlie Pellet, thank you so much. I'm Kayleigh Lyons in Washington alongside Mike Shepard today, where our top story is, no surprise, what Charlie was just talking about, the narrative surrounding the firing or lack thereof of the chair of the Federal Reserve, Jerome Powell. As earlier this morning, there were, of course, reports that President Trump actually confirmed that he discussed the idea of firing the Fed chairman with Republican lawmakers at the White House yesterday. I guess making such strong suggestions around the chairman's future that one of them, Congresswoman Anna Paulina Luna of Florida, felt that she could take to X to post, hearing Jerome Powell is getting fired, from a very serious source. But of course, it does not appear, at least according to President Trump right now, that Jerome Powell is indeed getting fired. He has no such intention of firing him, though he does look forward to replacing him about 8 months from now, and it doesn't seem that he's changing his tune on his dissatisfaction with the job the chair is doing and the fact that interest rates remain so high. Here's part of what the president said earlier.
He's not doing the right job. We should be saving $1 trillion a year in interest, when he talks about costs. We should be saving, think of it, $1 trillion a year. Add that with the tariffs and everything else. But he just doesn't want, he's a knucklehead.
He's a knucklehead. Keep in mind, these comments were made as the president was sitting next to the crown prince and prime minister of Bahrain, who was at the White House for an official visit. But obviously, he did not get much in terms of questions from the press. It was really all targeted toward the president and a lot about this subject.
So much about the Fed. Knucklehead was a new one from the president on this. But whether or not he moves on actually proceeding to fire, as threatened in private, the central bank chair, this does have market implications. And when the reports first emerged today, we saw the dollar drop. The Bloomberg dollar spot index dropped significantly right after those reports emerged. And I just checked now, Kayleigh, and it has recovered with the president's remarks saying that he has no intention of doing so right now and would look ahead instead to actually finding a replacement in normal time for Jay Powell.
Yeah, of course, his term expires in May of next year, so it really is not.
You're saying there's a lot of time for this.
Away. There's a lot of time also. It's not that much time that the president still has to be living under this particular Fed chairmanship. So we want to get into all of this and turn to our political panel. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick, of course, Stone Court Capital partner and Republican strategist. Jeannie, our Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. So, Rick, obviously, we are no stranger to the notion of the president teasing with the idea of doing something about the chair of the Federal Reserve. But for reports like this to emerge only for the president to shortly thereafter deny them, but still berate the Fed chairman for not lowering interest rates, is all of this just an attempt in your mind to change the news cycle?
Yeah, I don't think it was that thoughtful. I mean, he's sitting around with a bunch of recalcitrant Republican conservatives from the House trying to talk him into a cyber bill, and he goes off script. Shocking, that Trump would go off script. And starts talking about wanting to fire Jerome Powell. Hey, what do you think? I mean, this is typical for him to, take important decisions like this and throw them out to a crowd. And I'm sure this was like a really special moment in the White House for a lot of these members, and that's when the leaks all started. So I'm sure the White House today read all this and said, oh, my God, the last thing we need is a firestorm on Jerome Powell today. Our intention is not to fire him right away, and so let's tamp it down. So I don't think it's a matter of trying to avoid an Epstein story or something like that. You know, he even just now addressed the Epstein controversy, you know, from the Oval Office, you know, with the Bahraini Prime Minister. And so, you know, he's putting it out there himself. So I don't think it was that thoughtful. I think this was a mistake last night. They got out of control. And the White House did damage control this morning, you know, with these statements by the president.
Jeannie, is this the kind of issue that actually resonates with voters? We take, of course, a keen interest in anything that happens regarding the Fed and the fate of its chairman and its decisions on interest rates. But how do voters view this sort of back and forth and drama over whether Trump will or won't relieve the Fed chair of his duties prematurely?
Yeah, first of all, Mike, I haven't heard the term knucklehead since, like, I read the Archie comics, you know, back in the day. So that was a new one for me as well. Yeah, you know, for voters, they're not paying particular attention to who the Fed chair is, when or his term ends or not, how Donald Trump deals with him. But what does matter to them, obviously, are issues like interest rates, inflation, and everything else. And so, you know, the economic implications of this, as you know better than anybody, are so real for voters that does matter. And, you know, one of the fascinating things that I heard recently was that the White House stepped up this attack looking for cause to potentially remove Jerome Powell. That's what Section 10 would require, cause. And that happened when Jerome Powell refused to say whether, in fact, he would step down as governor when his term ends. And so I think what we're seeing here is a real concern on the part of the White House that even if they don't remove him early, he's not removed for cause, he stays on after his term ends as governor. And I think, you know, if nothing else, Donald Trump is trying to use rhetoric to say, you are not welcome. You must see the door either early or by May when your term ends.
Probably one of the reasons that the Treasury Secretary Scott Bessent talked about historical precedent of former Fed chairs stepping away from their governor roles as well throughout the course of history. But as we consider this whole idea of whether or not this is an affront to Fed independence, Rick, while it's one thing to consider what would happen to Fed independence if the president were to take the step of firing the Fed chair, what about the question of Fed independence if he, after this Fed chair's term expires, installs a loyalist who's committed to him to lower interest rates as chair of the Federal Reserve? Kevin Hassett, of course, we understand, is in contention, but the president said he's only interested in low interest people. Doesn't that raise credibility questions of its own?
Yeah, I think presidents have always had a point of view when they've appointed Fed chairs, including Donald Trump appointing Jerome Powell, that there was a certain specific policy that they would adhere to and would be somewhat predictable, kind of like putting a Supreme Court nominee into office. So that shouldn't be a surprise to anybody. I would say one of the things we have to understand in all of this is White Houses don't generally sometimes talk with one voice. And this one is no exception to that rule. I mean, we've seen a whole concerted attack on Jerome Powell and his management of the refurbishing of the Fed building, attacks of misuse of $2.5 billion, even requiring the Fed chair to launch a internal investigation to make sure everything is on the up and up. So those kinds of things coming out of the White House certainly would direct people to the idea that they're going to look for a cause reason to replace Powell. But at the end of the day, the president's voice is the only one that matters, and he's made it clear today that that's not going to be the plan in the short run. But you can imagine if you're Jerome Powell, you would run, not walk, to the nearest exit the day after your term is up. Why would you want to stick around in this administration? But the board is ultimately influential. So if you are talking about putting someone like a Kevin Hassett who would look for lower interest rates right away, they've talked even in terms of 3% decline in interest rates, you've still got to get that through the Open Market Committee. You've still got to get through a board that may or may not have the same point of view and certainly hasn't had that point of view up until today. So it's not as easy as just putting your guy into office, making sure that the chairman is consistent with your views, and then telling him what to do in the process. It just won't work as easily as the president would like it to.
Jeannie, I'd like to turn now to action elsewhere in Washington, and that's on Capitol Hill. The Senate is about to begin yet another one of those famous vote-a-ramas, and this time on the so-called rescissions package. This is an effort to claw back some of the money from agencies that have been targeted, for example, by DOJ, but also by the administration at large for reductions. Are Democrats in any kind of position to stop this train, and what is the argument that they are making about this whole process and this move?
Yeah, I mean, you and Kaylee did not have enough of a break since the last Vote-a-rama, so they wanted to give you another one just if you missed it. Here we go again. And, you know, Democrats don't have a lot of say in any of this. I think for, you know, the three amigos, as Punchbowl called them, Murkowski, Collins, and McConnell, who voted against the bill last night, if they could find a fourth, and some people are talking about somebody like Tom Tillis, I think it's very doubtful, they may be able to put the brakes on this. But I think at this point, the train is going forward. The problem for Republicans and what they're hearing from Democrats is if every time we allocate funding, you're just going to claw it back, we will not be able to work with you in good faith on the upcoming budget. And I think that's a particular concern for Susan Collins as chair of appropriations. And that's partly, in addition to the substance of the bill, why she voted against it. And so we're going to hear that repeatedly from the Democrats. And I would just note Lisa Murkowski's discussion last night on the floor about what this does to the power of Congress vis-a-vis the executive branch is the story here. They are giving up power. Institutions don't do that easily. And this is what has been happening throughout this Congress.
Well, Rick, as we consider those 3 no votes in the Senate, there's also 3 no votes up on the board in the House right now on this vote for a motion to reconsider the rule that failed yesterday that will advance these multiple pieces of crypto legislation for House Crypto Week. And those 3 no votes right now are inclusive of members who were at the White House yesterday with President Trump. And President Trump said he convinced them all to vote for this rule. How are we going to get out of this song and dance pattern of people taking a stand by voting no on something the president speaks to them? Ultimately, they roll over, though I guess we'll see if they decide to roll over on this one.
Yeah, the 3 just indicated. I'm shocked that they didn't roll over already. I mean, usually it works, right? The president brings you over to the White House, you know, he creates a little news with Jerome Powell, entertains them all, and then elicits a commitment to move forward with the bill. He wants to sign this crypto bill this week. This is Crypto Week. He's out there talking about it every day. This would be an embarrassment to the Speaker to not be able to pull this bill out of the House. Now, of course, it came over to the House with some changes from the Senate. Senate jams the House again. Boy, this is a headline we're going to see over and over and over again in the course of this Congress. And I'm not surprised that they're having trouble, you know, lining up, especially some of these more conservative members that have been a problem on other legislation. That being said, I just cannot imagine on a piece of legislation like this that is, I argue, inconsequential compared to everything else they've walked the line to say yes to. Massive deficits, huge government spending, you know, all that kind of stuff, cuts in Medicaid. I mean, like, if you are willing to do those things, what in the world are you doing pitching a fight for cyber?
All right, Rick Davis and Jeannie Shanzano, our political panel today. They'll both be back for more in our second hour of Balance of Power, which is coming up in just a minute as we continue to follow the movements in Congress and continue to follow the story on the Federal Reserve Chair, Jerome Powell, and his relationship with President Trump right here on Bloomberg.
from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
President Trump says he is not planning to fire the chair of the Federal Reserve, Jerome Powell. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines alongside Mike Shepard in Washington today as the president pushes back on reports that he was considering firing Chairman Powell, suggesting that he'll just wait another 8 months, although it might be a little longer than that mathematically, to pick a new Fed chairman, Mike, though he's not backing down from his criticism of this current Fed chairman and his push to continue to lower interest rates.
He sure isn't. And what was fascinating in hearing him speak about this and expressing his dissatisfaction with Jerome Powell was his invocation of interest rate costs for the government, saving $1 trillion for the U.S. government. And that is something weighing on the president now after seeing his big tax and spending package advance, pass, and then be signed by him, and then realizing that perhaps there may be some additional costs, additional burden in terms of debt on the U.S. government.
Well, and on the subject of legislation, not just the one big beautiful bill, but he initially made remarks to Republicans gathered at the White House yesterday about the possibility of firing the chairman as he was pushing them to get in line to pass a procedural hurdle on crypto legislation in the so-called Crypto Week in the House of Representatives. Those votes are ongoing, and we're going to get the latest on that story and some reaction to this news around Chairman Powell from the chair of the House Ways and Means Committee. Congressman Jason Smith is going to be joining us this hour.
Yes, and we'll find out whether or not that attempt at persuading lawmakers actually worked.
Yeah, still an open question as we speak here, just as markets are dealing with the question of what exactly is going on with the independence of the Federal Reserve. They have been whipsawed throughout the session on these conflicting headlines coming from inside and outside of the White House. So let's get a check on those now as we begin with Charlie Pellet looking at Wall Street for us from New York.
Thank you very much, Kayla Lines. Thank you, Mike Shepard. Nice setup here with the Dow, the S&P, NASDAQ. Volatile day today. All those fast-moving headlines out of the White House. We got you covered here on Balance of Power. Here's where we stand. The S&P now higher. We're up 8 points. S&P 500 index at 62.52. That's a gain of 0.1%. Worst level of the day, we saw the S&P at 62.01. You recall yesterday we did hit a record briefly on the S&P at 6,300. Right now in the green, up 7. The Dow higher by 95, up 0.2%. We've got NASDAQ up 15 right now, up by about 0.1%. 10-year 4.47%, with the 2-year 3.89%. The 30-year 5.04%. Gold up 0.7%, 33.49 the ounce. West Texas Intermediate crude retreating by 0.2%, 66.39 for a barrel of WTI. Bitcoin up 2.5%, 119,345 on Bitcoin, and the Bloomberg Dollar Spot Index trading lower by 0.3%. Another batch of solid gains from financial giants today, including Goldman Sachs, Bank of America, and Morgan Stanley. Mixed reaction, though, for the stock price. Goldman up 0.1%. Morgan Stanley tumbling 2.6%. Bank of America lower now by 1.1%. Coming up 2:30 p.m. Wall Street time, we'll be sitting down with Bank of America CEO Brian Moynihan. Recapping stocks higher in a volatile session. Got to keep it locked into Bloomberg for the latest developments. S&P right now higher by 7, up 0.1. The 10-year 4.47%. Balance of Power continues right now, and back we go to Washington. Once again, your hosts Kaylee Lines and Mike Shepard.
All right, Charlie Pellet, thank you so much. Watching how markets are watching the evolving headlines around the future of the Fed chair, Jerome Powell. And as we consider that future question, we also are watching what's happening presently on Capitol Hill, as the House right now, as we speak, is voting on a motion to reconsider a rule that failed yesterday. This is a procedural hurdle to try to get them to be able to vote for final passage on various pieces of crypto legislation, because yes, it is still crypto week in the House. And what they want to consider is a stablecoin bill, the Genius Act that was passed by the U.S. Senate already, a market structure legislation package called the Clarity Act, and then some anti-CBDC legislation as well. That rule that failed yesterday wasn't supposed to see another failure again today, after President Trump met with the holdouts at the White House yesterday and came out saying they had all agreed to let this rule pass. Yet there's 3 no votes on the board right now. So let's get the latest with Megan Scully, who leads our Capital Influence team here in Washington, covering Congress for us. So Megan, is there a chance that we see failure again here? I thought the president said he had a deal.
Yes, he did sound like it was all wrapped up tight, didn't he? But it does appear that it is in trouble. Now, votes can change before they gavel it. So I'm sure that there is a lot of lobbying happening on the floor right now. The president definitely doesn't want to see this go down, particularly after calling all of these hardliners into the Oval Office last night. So, but we are watching it closely, and we'll see. This does not, if this does go down, it does not necessarily mean Crypto Week is over. It could certainly, they could strike another deal. They could bring this up again within a matter of a few hours and get this all back on track, as we've seen happen again and again this year.
What are the hardliners asking for and maybe not getting if we're seeing them still hold out or drag their feet, despite Donald Trump trying to get them aboard?
So last night, what they were asking for was to attach this central bank language to the stablecoin bill.
It's all about the Fed.
Yes, which essentially would force the Senate's hand, would require the Senate to amend its own stablecoin bill, which it doesn't want to do. It just wants the House to pass the Senate bill so they could all move on. But this would force the Senate then to address the issue later this week, presumably. As for what is the issue right now, we are trying to find that out.
Well, it's interesting. We spoke with Senator Tom Tillis of North Carolina on Balance of Power last night, Megan, about the idea that the Fed, or the House rather, could try to change the Genius Act and send it back to the Senate. And he suggested that could be a deal breaker, that the House shouldn't do that. The problem is if the House doesn't do that, the House once again has gotten jammed by the Senate. This is just lawmakers in Congress, at least some of them, feeling like there's a repeated pattern here where they don't have the power, the authority.
Yes, I think part of what we are seeing here, the undercurrent here, are these hardliners feeling like, as you said, that they are being jammed by the Senate, that they need to sort of take whatever the Senate ultimately passes. And you're talking about people who don't typically work well in that area. Marjorie Taylor Greene, Victoria Spartz, several others. So they are trying to essentially lay down a marker here and make a point and say, you know, we are our own chamber, equal powers, all of that. And I think that's a lot of what is playing out here.
Megan, we've seen Bitcoin climb to new records this week in anticipation that there would be a breakthrough on at least the Genius Act. How significant is this for the industry, for the crypto industry, which is trying to shed some of its, I guess, outsider image?
Right. Yes. This package of bills, all very heavily supported by industry. This is something that for the last year plus they've been trying to shepherd through Congress. So this is an incredibly big deal for the industry as a whole, and its top priority, particularly the stablecoin bill. You know, this year, failure to get this through. We saw yesterday, you know, stocks drop after the procedural rule fails. So I presume, you know, everyone in the industry and elsewhere is looking at this vote going on right now very closely.
Well, and one quickly on a vote that could happen shortly, Megan, in the Senate, specifically, the rescissions package, where we saw two procedural votes yesterday having to be a tiebreaker, with Vice President J.D. Vance casting the tie-breaking vote. Is there a guarantee that this is going to actually be able to pass these $9 billion in rescissions?
Well, I don't think anything is a guarantee right now, as we're seeing play out on the House floor. But what we are kind of continuing to see in the Senate is Thune seems to be, the majority leader, seems to be very attuned with his caucus, and he's able to lose 3 with J.D. Vance, you know, casting the tie-breaking vote. We saw that as long ago as Trump's nominees, like Pete Hegseth, getting over the line with tie-breaking votes. And, you know, I would suspect we're going to see more hemming and hawing. We're going to see some consternation, but ultimately, you know, perhaps J.D. Vance coming in with the tiebreaker. I do think the decision to protect the AIDS funding, the PEPFAR funding yesterday, that is a very popular program, and the decision to protect that instead of stripping it from the already appropriated funds, that surely sweetened the pot for some on the fence Republicans.
All right, Megan Scully leading our Capitol Influence team here in Washington. Thank you so much. And it's to the Capitol or Capitol buildings that we go now. Live on Capitol Hill, we're joined by the chair of the House Ways and Means Committee, Congressman Jason Smith of Missouri, is here with us live on Bloomberg TV and radio. Mr. Chairman, welcome back to Balance of Power. There's a lot we want to discuss with you, but if we could begin with Crypto Week, which perhaps is not going as smoothly as you or many of your colleagues may have intended it to. Is this ultimately going to move forward, or do you get the sense that the holdouts are still willing to hold out on this trio of legislation?
Let's just look at the 119th Congress. It has some ups and downs along the way. We just passed the biggest piece of legislation in years in the One Big Beautiful Bill just the last week that we were in session, and people said that there was no way that we could ever do it. And I continue to say failure's not an option. Of course, the crypto legislation that is on the floor is within other committees of jurisdiction from the House Ways and Means Committee. We're working on our own crypto items that's not on the floor. But I truly believe that we'll be able to iron it out, get it together, and pass it. We have always, whether it's funding government, whether it's the debt extension, people didn't think we could do it. It got a little rocky, but we still got it done. And it's going to happen the same here today.
Chairman Smith, if we see passage today or even later this week of the Genius Act, do you anticipate that this will clear a path eventually for something on market structure? We know that this is another bill that has been in the works, but it seems a little bit further behind in terms of development and perhaps support too among lawmakers.
I think without a doubt, there's a comprehensive effort to make sure that we are the crypto capital of the world. That's what President Trump has said over and over again. We had a hearing this morning in the Ways and Means Committee on cryptocurrency and taxing digital assets. This is another point that has to be addressed and looked at. And that's what the Ways and Means Committee is focused on from this gamut within the digital asset space. It's super important, as you know, to the markets, to investments. There's 50 million Americans that are involved with digital assets. So that's pretty substantial. And we need to make sure we continue to be the world leader.
Well, of course, markets and investments also care very much about tax policy, which is why we all paid such close attention to the tax changes and extensions that were included in the One Big Beautiful Bill Act, one piece of budget reconciliation. But Mr. Chairman, the chair of the Budget Committee, Jody Arrington, told our colleagues this week that he wants to work on a second budget package to pass by the end of the year. I wonder if you see that as likely, given how hard it was to get the first line across the finish line, and what, if any, tax changes you would want included in a second reconciliation package?
Well, let me just say there has never been two partisan reconciliation bills that have become law in the same year. It's never happened before. So trying to do a second one is doing something that when the Democrats controlled the White House, the House, and the Senate, they attempted to do two and then ultimately couldn't pass Build Back Better. And then the next year, they did a second reconciliation bill, but it wasn't in the same year. So it is extremely difficult to do, because passing a budget reconciliation is not easy. As you saw, what we passed just recently, which is the largest tax cut in U.S. history, the largest spending cuts in U.S. history, the largest welfare reforms in U.S. history, the largest one-time investment in border security in U.S. history, that wasn't easy. And we had to pass it just in the House. The first initial vote was 215 to 214. Right. So it was by one vote. The Senate, J.D. Vance had to do the tie-breaking vote. So it's very, very difficult. But if we come up with a reconciliation package that addresses needs for working families, small businesses, and farmers, we'll get it done. But it needs to make sure it addresses those points.
Chairman Smith, I wanted to shift gears a little bit and talk about tariffs and tariff revenue. To set up the conversation, I wanted to bring in something we heard from Peter Navarro on Friday on this program, talking about tariff revenue.
I would say that for the American people, these tariffs are a great boon. I brought a chart here. It shows that we've already collected like $100 billion of tariffs.
A record for a
alone.
single fiscal year.
Yeah, the tariffs are working, and they were these kind of revenues that we're getting. It's a very important part of the big, beautiful bill in terms of financing that as well.
Chairman Smith, how much are you expecting on the committee in terms of revenue from tariffs that the president has imposed this year already, and the other tariffs that we are expecting, not only on U.S. trading partners, but on sectors, on goods in various sectors, including drugs and semiconductors and autos and so forth?
So let's just look at the last month in June. This is something that a lot of people's not paying attention to or discussing. If you look at the revenues that came within the federal government and the expenses we had, last month was the first time since June of 2016 that we had a month that created a surplus, not a deficit. Of course, we need a surplus for 12 different months, but if you look into why did the month of June actually have a surplus and not a deficit spend, it's because of the increased tax revenues, but also the increased tariff revenues. Those are the two biggest issues that led to making sure that government was balanced for the month of June. So tariffs do play a part of the role. I've said all along, when you're looking at the fiscal sanity, the fiscal responsibility of government, you have to look at three different legs. You have the tax issue. You need certainty in the tax code. We just finished that with the one big beautiful bill. Then you have the trade mechanisms, and then you have the deregulation. Once you do those three legs, that will create an economy that will go gangbusters, and it will help us balance our budgets. And these trade agreements that the president's working on, you're even having CEOs now of some major U.S. companies that's going out there saying, I was opposed to the president's tariff policies, but they're really not making an impact. They're not inflationary. They're not raising prices, and I think they're working.
Well, Mr. Chairman, we know that President Trump is paying close attention to that lack of an inflationary read-through, at least at this time, from his tariff policy, and he sees that as further justification for his view that the Federal Reserve should be cutting interest rates right now. I'm sure you're aware of the reporting, which the president has pushed back on, that he was considering firing the chair of the Federal Reserve. Do you believe he would have the legal authority to do that? Is questions over the cost of the renovations to the Fed buildings here in Washington justification for firing for cause?
First off, I will tell you, I agree with the president that interest rates should be cut. Interest rates were raised because we went through an inflationary crisis during the Biden administration where inflation went up 22%. We now have the lowest inflation that we've had in 4 years, but yet they've not reduced one time the interest rates. So he has a valid point when you're talking about the interest perspective. If you look at other heads of different agencies, whether it's the IRS commissioner chose to step down whenever President Trump was elected so that President Trump could put in place his person. This is something that I would consider Mr. Powell to do. He should consider resigning because clearly he's not aligned with the President of the United States. Other people's done that with the agencies. I think Chairman Powell should consider his place in government right now.
All right, Mr. Chairman, we appreciate you joining us. Congressman Jason Smith, the Republican representing Missouri, of course, and chair of the House Ways and Means Committee, here with us on Balance of Power. Thank you so much. And that is another question, Mike, of course, is not just whether or not the chair of the Federal Reserve could end up being fired, but whether he could resign under what is still immense pressure from not just President Trump, but others in the administration.
Even though he has indicated that he would do no such thing, and he has tried in every way possible to resist that pressure.
Yep, and has also tried to say repeatedly that there is, it is not applicable with the law to fire the chair of the Federal Reserve. We'll see whether or not we have to actually test that legal theory. We'll continue to follow this story here on Balance of Power on Bloomberg TV and radio.
7:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all advancing. NASDAQ 100 index lower, little change, down by a point. Bottom line here, a lot of green on the screen. This after a day with extreme volatility. Speculation about the fate of Fed Chair Jay Powell causing volatility in markets, which was mostly quelled after President Trump said he has no plans to fire Powell. Keep it locked in to Bloomberg Television and Radio for the latest developments out of the White House in Washington. Complete coverage right here on Balance of Power. So right to the numbers, S&P up 11 now at 62.55. That is a gain of 0.2%. We've got the Dow up 136, up 0.3%. NASDAQ up 32 for the NASDAQ Composite Index, up 0.2%. Mag 7 Index up 0.4%. The 10-year 4.46%. The 2-year 3.88%, and the 30-year 5.02%. Spot gold up 0.8%, 33.51 the ounce. West Texas Intermediate crude down 0.2%, 66.41 for a barrel of WTI. And Bitcoin, major move there, up 2.6% at 119,522. Bitcoin again close to a record. Congressman Jason Smith, a Republican from Missouri and chairman of the House Ways and Means Committee, saying moments ago here on Balance of Power, it is time for Powell to consider stepping down. Stock news, keeping an eye on shares of ASML, down 8.9%. The company's CEO is walking back its sales forecast for next year, blaming trade disputes and global tensions. Recapping stocks higher in a volatile trading day with the S&P up 10 now, up 0.2%. Balance of Power continues right now. Back we go to Washington. Once again, your hosts, Mike Shepard and Kaylee Lyons.
All right, Charlie Pellet, looking at the markets for us. Thank you so much. I'm Kaylee Lyons alongside Mike Shepard here in Washington today. Welcome back to Balance of Power on Bloomberg TV and Radio, where we just spoke with, as Charlie mentioned, the chair of the House Ways and Means Committee, Congressman Jason Smith, who, yes, said the chair of the Federal Reserve should resign when we asked him about whether or not President Trump could legally fire Chairman Powell, whose term is set to expire as chairman in May of 2026. But President Trump, of course, in the Oval Office, when questioned by reporters about this earlier today, suggested he's not planning to fire him, in part because May 2026 isn't all that far away, and he soon gets to pick Powell's replacement.
We get to make a change in the next, 8 months or so, and we'll pick somebody that's good, and we'll pick somebody. I just want a fair job. We want to see lower interest rates. Our country deserves it. We're making a lot of money. We're doing great as a country. We have no inflation, record stock market, record business, record everything. Everything's a record now. We had the worst inflation in history under Biden, and now we have almost no inflation. We've done a great job, and we should have the interest rates cut.
President Trump, perhaps, Mike, feeling empowered to talk about the lack of inflation by the inflation data we got today, PPI, literally 0% gain month on month.
And yesterday, too, the CPI, at least at the top level. If you drill a little bit
Right.
lower into actual categories like appliances, we are seeing some upward price pressure. But for the White House, that top level number in CPI also surely gave the president some free rein to talk about cutting interest rates. And that's something that's critical to his agenda. He wants to see mortgage rates go down, and he also wants to see the cost of investing for business go down, too, given all of his interest in having plants built across the U.S.
Yeah, and that's why President Trump says when he's choosing Powell's replacement, he's only interested in low-interest people. So on that note, let's bring our political panel into the conversation. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. Rick, of course, Stone Court Capital partner and Republican strategist. Jeannie, Democratic analyst and senior democracy fellow at the Center for the Study of the Presidency and Congress. Jeannie, I wonder how you read into the reasoning President Trump has around interest rates that Mike was just referring to, that actually, at the end of the day, what this really is about for him, in large part, he says, is about the interest burden of the United States, making sure those payments are lower. Is this the president that maybe is a bit more worried about our debt and deficit, knowing that his one big beautiful bill just passed that will add to it?
Yeah, I don't know of a president, Republican, Democrat, anywhere in between, who has not wanted lower interest rates. So in this way, Donald Trump is perfectly in keeping with every, not just president probably, but every politician or most of them. And sure, he is going to be concerned about the interest rates. He's going to be concerned about debt and deficit, because this reflects on him. The number one reason he was elected, according to those exit polls in 2024, was that he promised to be able to manage the economy in a way that people felt Joe Biden simply wasn't doing, that he was a sound manager as a former businessman of the economy. And so as he sits here today, 6-7 months in, he knows he owns this economy, and interest rates are something that we all feel as consumers and voters. So it does matter. And we all, of course, see the ticking up of the deficit, and that matters as well. So he's looking at the same numbers we are. Voters feel it, and so it matters to him.
Rick, when it comes to numbers and what the president and his allies in Congress as well are looking at, how much are they factoring in the market reaction? It was quite negative when those reports began to emerge that the president had not only floated the idea of firing Jay Powell in private, but even waved around a letter. We've seen those numbers recover a little bit, but how much of this is a factor in their thinking?
Yeah, I think quite different from his first term, where he seemed hypersensitive to market changes. He seems a little bit more immune to them in this term. Obviously, the biggest crisis he'd had in the markets was when he got into a bit of a trade war earlier in his administration and backed right off of that, yielding us a new acronym, taco tariffs, and the taco trade. And so I think he's thinking more long term on this. I think you guys are absolutely correct that he's got the deficits in his rearview mirror, looking at those every day, realizing that these interest rates that keep ticking away are not very dynamic. They're very much a penalty to any administration that runs up the deficit, and that's exactly what he's just done with his big, beautiful bill. But the other key component to his entire budget strategy is economic growth. And he needs these low interest rates for economic growth. So maybe less focused on the markets today and much more focused on new building development, manufacturing starts, things like that, that really require lower interest rates in order to create that kind of economic growth, which, of course, all his models that he argued for in selling the big, beautiful bill were 3.5%, 4% GDP. He's a long way off of that. And so I think that's what's really fueling his interest here.
Well, but doesn't that just speak to the kind of catch-22 for the president, Rick, where he wants juice to grow, or he wants growth to be juiced, so he wants interest rates lower, knowing growth might take a hit ultimately from his tariff policy, depending on the extent to which tariffs are actually implemented and for how long they stay in place. But it's those very tariffs that is keeping the Federal Reserve on the sidelines for now, not wanting to cut interest rates because of inflation. Can't we chalk up all of the difficulty he has around interest rates to his own policy, not necessarily the Fed's?
Yeah, I think that this is a massive change. This is not a small change. And if you follow sort of the Mar-a-Lago Accord in the significant alterations of the global economic infrastructure that exists today that this administration is pursuing, there's a lot of friction. And I think this is the kind of friction you're seeing happen right now on these issues. You know, could he get the Fed to move more quickly if there weren't pressures on prices because of tariffs? Absolutely. But he needs those tariffs to generate revenue in order to reset the financial relationships. And of course, one of the fundamental aspects of his realignment economically is getting down the trade deficits. And so, you know, he's not going to give that up. What he wants to do is get rid of Jerome Powell.
Jeannie, it's been very hard to keep up with the fast-moving pace of everything that is happening here with Trump, from Jay Powell to tariffs. How do Democrats keep up with this, and can they form a coherent argument around the economy that packages all of this together?
Yeah, they're going to try. Now, Mike, I always say Democrats and forming a cohesive sort of narrative to sell at an election, it's something like an oxymoron. It doesn't work so well all the time. But given the big, beautiful bill, they should be able to do that. And, you know, what's working against them are things like Mamdani's potential election in New York City. But putting that aside, they are going to be arguing, number one, about healthcare and the impact of this big, beautiful bill on healthcare, the impact of inflation. We've seen that tick up, the impact of debt and deficits on their children, their grandchildren. But I think most important to make the case that Donald Trump is doing the bidding of the billionaires and the very wealthy, and he is leaving aside the people he claims to care most about, the working and the middle class who bear the brunt of all of this, including, by the way, on his tariffs. I know his talk about tariffs is always they, meaning the other country, will pay 19% in the case of Indonesia. The fact is Americans at home will bear the brunt of that, and it is a regressive tax. So Democrats have to make that case.
All right, Jeannie Shanzano and Rick Davis, our political panel here on Balance of Power, both of them Bloomberg Politics contributors. Thanks for being with us, as always, here on Bloomberg TV and radio. And we want to go live now here on Bloomberg to the North Lawn of the White House, where we find Bloomberg's chief political correspondent, Anne-Marie Hordern, having just been in the Oval Office with President Trump and having the chance to question him about his intentions with the chair of the Federal Reserve. So, Anne-Marie, obviously some pushback to today's earlier reporting.
Yeah, a lot of pushback from the president in the Oval Office. He talked about the fact that he is not looking or planning to fire Jay Powell. When I asked him about this draft letter, did he write it? Did he wave it in front of congressional Republicans at this dinner last night? He said, no, there is no letter. He discussed the, quote, concept of the idea of firing the Fed chair. He actually said that lawmakers, most of them were really in favor of it, but he said he is more conservative than they are. So he pushed back on this notion, but he continued, of course, to bring up his gripes with Fed Chair Jay Powell. One, of course, being the fact that he thinks the Fed should be lowering interest rates, and we have not seen the Fed do that, of course, since last year before the election. And now this new one that you've seen a lot of administrative officials really start to push, going after the Fed chair for the renovations that are taking place at the Federal Reserve building. So he kept those talking points, but he made it pretty clear that at this moment he has no plans to fire the Fed chair, which of course would open up a huge legal battle, because this would be a precedent in American history.
Anne-Marie, are you getting a sense that that whole question of the renovation of the Fed headquarters is emerging as a coherent means of arguing for and justifying the Fed chair's exit?
Well, they definitely are looking into it. And even within the Fed, we do know that the Fed chair, Jay Powell, is asking questions about it. How did the renovations become over budget, et cetera? So he clearly wants to make sure that he has the answers if there are those questions. But this seems to be a new line of attack on the Fed. But the president continues to go after what for him is the biggest problem, which is where interest rates are right now, and he wants to see them lower. Of course, a lot of economists on Wall Street, even ones that are sympathetic to the president's view, like Neil Dutta of Renmac, who says the Fed should be lowering interest rates, said if you were to fire him, it'll have the exact effect in the market that the president's looking for.
Yeah. Well, it all comes down to the behavior of the bond market, I guess, at the end of the day. Anne-Marie Hordern live at the White House for us. Thank you so much for being here on Balance of Power, and we'll have more straight ahead. I'm Kaylee Lyons alongside Mike Shepard right here on Bloomberg TV and radio.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Turbulent day for U.S. markets. Stocks higher right now, but stocks have been whipsawing as President Trump denies plans to fire Fed Chair Jay Powell. S&P up by 9 right now, 62.52. It has been a day of fast-moving developments out of the White House. S&P right now up by 0.1%. Bloomberg Television and Radio got you covered on any and all developments involving the Fed chair. The Dow up 120 now, up by about 0.3%. Nasdaq, the composite index, up 19, up 0.1%. Nasdaq 100 index, full of big tech names, down 0.1%. Our Mag 7 index advancing 0.3%, with the 10-year currently yielding 4.45%, 2-year 3.87%, and that 30-year at 5.01%. Gold up 0.9%, 33.53 the ounce right now. West Texas Intermediate crude down 0.4%, 66.25 for a barrel of WTI. Citigroup is hiring 2 of J.P. Morgan Chase's senior bankers as the lender continues to tap its Wall Street rival for talent to bolster its own investment banking division. Again, recapping, speculation about the fate of Fed Chair Jay Powell causing volatility in financial markets. S&P up 8 now, up 0.1%. The 10-year 4.45%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Kaylee Lines and Mike Shepard.
All right, Charlie Pellet in New York, thank you so much. Both Wall Street and Washington paying attention to the narrative around the Fed Chair Jerome Powell with equal interest today, as President Trump, again, as we've told you repeatedly this hour, has said he is not planning on firing the Fed chairman, but he still is unsatisfied with the chair's performance and with the current state of interest rates, which he wants to see lower in the face of what he said in the Oval Office today, Mike, is, quote, no inflation. And at least looking at the PPI data that we got today, you could see how that technically might be true, at least in this particular instance, as both PPI on the headline and core Xing out food and energy month on month rose 0%.
It would be a very favorable reading for the president and his point of view, but it's only 1 month.
Yeah.
And the trend is something that Scott Bessent yesterday had pointed to before the CPI numbers came out. And what was interesting in our conversation with Stuart Paul earlier today is that he dug through the numbers a little bit more deeply and found some increases in appliances and other goods that suggest that, yes, tariffs are actually starting to have an effect at that level where consumers and, yes, voters too could start seeing them.
You know who else digs through the inflation numbers? Michael McKee, Bloomberg's international economics and policy correspondent, and he's joining us now here on Balance of Power. So, Mike, to the point that Mike Shepard was just making about it being what's actually underneath the surface of the data that ultimately matters. When you look underneath, it's not necessarily true that we see no inflation, as President Trump suggests.
That's right, Kaylee. What we saw was a drop in service industry inflation in the PPI that was strong enough, because it's a service industry economy, to push down the overall number, or to keep it flat rather, which on a year-over-year basis brought down the PPI inflation numbers. But the goods inflation went up, and we saw goods prices rise on a number of areas that are tariffed. So for the Fed, they're going to be looking at this and saying there's evidence that tariffs are going to bleed through into the economy, and they are going to cause prices to go up. I go back to what Mike just said about it's only 1 month. So the Fed's going to want to make sure that this is a continuing pattern, and it could get worse before they do anything. So even though this would make the case to somebody who didn't understand economics, like perhaps the person in the Oval Office, it's not going to make the case for the Fed. And so I suspect that the president is going to be disappointed at the July meeting, even if the numbers suggest that inflation is somewhat tame.
Now, the Fed chair has insisted that the law backs him up in staying in his role, but he is under significant pressure from the administration to maybe move on, and perhaps move on once his term ends and leave the board. Do you see or get a sense that he may decide to stay on after all once he leaves his role as chair?
There's sort of a unanimous feeling, Mike, among the people I've talked to, both at the Fed and in the economics profession, that The only reason Powell would stay on after the end of his chairman's term is if he worried about the Fed as an institution. If the president put in somebody who was going to be a bull in a china shop and take away credibility from the Fed, he might try to stay on. But even he knows that that would cause problems for the overall Fed, because in essence, you'd have two Fed chairs. You'd have somebody the president appointed whom the markets may not want to listen to, and then you'd have Jay Powell, whom the markets are used to listening to. And if the new chair said something, Powell could contradict it, and that would really throw markets for a loop. So it would be difficult for the Fed if that happened. But if he thought it was a bad enough situation, he might do that. And I think that's why he's not saying he's going to leave. He's trying to use that as a bit of leverage on the White House to keep them from going too far.
Well, as we consider how the markets view all of this, Mike, it ultimately is the bond market that will dictate the interest rates that are actually paid on things like our national debt, which President Trump said in the Oval Office, once again, is really his issue with where the Fed funds rate is right now. Let's remind ourselves what Trump said earlier.
He's not doing the right job. We should be saving $1 trillion a year in interest, when he talks about costs. We should be saving, think of it, $1 trillion a year. Add that with the tariffs and everything else. But he just doesn't want. He's a knucklehead.
I'll leave the knucklehead comment aside for now, Mike, but if ultimately the objective here is to make sure that rates come down to the credibility point that you were just making, isn't there a chance that even if the president were to get what he wants, either through a new chairman or the Fed actually cutting rates under pressure, that then its credibility is a problem, the bond market doesn't buy it, and it doesn't actually change the amount we have to pay in interest or makes it higher?
Yeah, absolutely. That's the base case for the opponents of all of this, is that the president isn't going to get what he wants, because while the Fed can lower short-end rates, they can't affect long-end rates. That's the province of the markets, and the markets are going to decide whether they think there's a possible inflation problem or whether they think that there's a debt problem, and they're going to react to it. So odds are that if the president put in a toady who basically tried to force through a rate cut, the markets would send rates much higher. And that's another reason people just don't understand what the president's problem is here, because his strategy for getting lower interest rates is kind of the opposite of what you need to do.
Indeed it is. Michael McKee, Bloomberg International Economics and Policy Correspondent. Thank you so much. And as we watch this here at Bloomberg, as Wall Street watches this, we know Capitol Hill is watching this as well, and people who used to spend a lot of time on the Hill.
Well, that's right, Kaylee. And we're joined now by Patrick McHenry. He is the former chair of the House Financial Services Committee and former Speaker pro tempore and a Bloomberg contributor. Chair McHenry, we're so glad to have you with us today. You have to be watching this Fed drama unfold today with a certain amount of, I don't know, nostalgia or maybe an insider's appreciation of what is going on. Now, is it your sense that the president actually is serious about what he said to lawmakers behind closed doors last night, or is he more serious about what he said in public today at the White House?
Well, both things can be true. What this president has been very clear about is that he doesn't like the interest rate policy of the Federal Reserve. He puts that fully on the chair of the Federal Reserve. So there are two things that can be true at once. One is that he doesn't like Powell's approach to rates, being too late at the beginning of COVID, and thinks that our rates should come down now. And then the second part is to see that the second part is that the Open Markets Committee is dominated by Biden appointees. So even if you remove the Fed chair, you still have an Open Markets Committee that has a different view than the president does. And you're talking about a Fed chair's term of office ending at the beginning of next year. So I think what we're seeing today is the president highlighting the fact that inflation is come way down, that the tariffs haven't had a dramatic negative impact on inflation, counter to expectations, and is trying to drive his economic message in light of what we know is the inflation print this morning. So all these things are complicated, and there's a lot going on here. But the key message that the president's trying to drive is an economic one, not a personnel conversation.
Well, I'd like to ask you about a separate live conversation happening as we speak, Mr. Chairman, on Capitol Hill right now as the House is moving toward reconsidering the rule that failed yesterday, a procedural hurdle to advance 3 different pieces of crypto legislation as part of Crypto Week. The rule that failed yesterday was because of a handful of lawmakers who actually convened with the president at the White House last night, a meeting which the president emerged from saying, we have a deal. They're now going to vote to pass the rule. And indeed, the chair of the Freedom Caucus, Andy Harris, confirmed that on X a few minutes ago that they will be voting in favor of the rule today. When do we break out of this pattern of people voting no initially, President Trump stepping in, and they ultimately decide to change their minds? What's the point of the exercise?
That is the point of the exercise, which is I'm going to stop your agenda, President Trump. You're going to bring me to the Oval Office. I will say to you, I love you, and I didn't want to hurt you. Give me assurances about some extraneous random thing, and then they vote yes. So what they want is the attention and love of the sun, the moon, and the stars. And right now in the Republican ecosystem, that is in the person of Donald J. Trump, who controls this party unlike any other politician in modern American history. He has control over his party and thereby the policymaking on Capitol Hill. So it is a messy way to do it. It is very embarrassing for congressional leadership to have to send members over to the White House for the president to close them again. But that's the process that we're going through. And inevitably, what they've shown, what policymakers on Capitol Hill have shown, especially the Freedom Caucus, is that they will cave, they will fold, and they must do that in the room with the person of Donald Trump, but they will inevitably fold for no change in policy. And that's what's happening once again with crypto. That happened on reconciliation. It's happened probably a half dozen times so far this legislative year, and will continue.
Chair McHenry, is it your sense then that this actually gets through this week? Do we actually see Crypto Week ending in this victory lap for crypto advocates?
Yes, we do. We see a bipartisan vote for the stablecoin bill, the Genius Act. And we see less of a bipartisan vote because of the maneuvers of the Freedom Caucus for the market structure bill, which brings clarity to 93% of the crypto marketplace. That's the bigger bill that will have to come later. But the stablecoin regime will have a nice bipartisan vote this week, which will show that crypto does have massive power within both of the parties, much more so in the Republican Party than the Democratic Party, but a significant group within the Democratic Party are pro-crypto.
Well, to follow up, Chair McHenry, how much more work does need to be done on that market structure bill to get it through to win the support it needs?
Well, my colleagues and I worked very hard for the last 5 years on crypto in the House of Representatives. And so we've got a pretty well-baked approach. Policymakers on both sides of the aisle who are engaged in policymaking, that's a smaller group, but they are well-versed in the set of policies that are in the Clarity Act, or last Congress called FIT 21. That is the market structure bill that brings clarity to commodities and securities and defines a digital asset and a means of exchange. So House members are much further along on this than Senate members. And so the Senate is going to have to take a lot of time to actually understand this policy, the trade-offs to go through this, and then go through the stages of grief before they can get to actually voting on a market structure bill. Hopefully that happens this fall, but it's going to take longer than expectations, unfortunately.
Well, Mr. Chairman, we just have a minute left. Is that effort in the Senate, knowing it would require Democratic buy-in, potentially disrupted by a rescissions vote we could see later today or tomorrow that Democrats obviously don't want to see? Do you see that disrupting potentially the appropriations process and any further bipartisan effort on crypto or other things?
Yes, I think when Chuck Schumer got played by President Trump and Elon Musk in the Doge process, that kept the government open at the beginning of the year. I don't think Schumer and the Democratic Senate will play the same rules, by the same rules going into the fall. I think the likelihood of a government shutdown is rather high, given the environment we're currently in. highly partisan environment we're currently in, and that will curtail a lot of serious policymaking that could otherwise be done.
All right, not an optimistic note to end on, but we'll leave it there, Mr. Chairman. Thank you, as always, for joining us. Of course, former Congressman from North Carolina, former chair of the House Financial Services Committee, Patrick McHenry, now a Bloomberg contributor, here with us on Balance of Power. And there's still much more coming up on Bloomberg TV and radio. Just about 30 minutes from now, 2:30 p.m. Eastern Time, a conversation with the CEO, Bank of America, Brian Moynihan. And at 5 p.m., we'll be speaking with the head of the FHFA, Bill Pulte, who is pushing for the resignation or firing of Fed Chair Jerome Powell. So make sure to see us on the late edition of Balance of Power right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everyone, live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. It is Bloomberg Business Week Daily on this Wednesday, July 16th, 2025. This is a Fed Wednesday, and it was a Fed Wednesday always because we're expecting the Beige Book to cross just any minute. We're going to bring you those headlines as soon as we get them. Stuart Paul is here to talk about it, but also Katie Greifeld. A Fed Wednesday because of everything happening at the White House and reports out of Washington about the fate of Jay Powell.
Yeah, a lot of back and forth here. I have to say, I had to leave the building at about 11 for an hour.
Okay.
And in the time that I was out, when I left, apparently he was considering firing Jerome Powell soon. And now I'm back, and the reporting is currently that no, it's not out of the realm of possibility, but it's not imminent, it sounds like.
Well, we did see whipsaw in equity markets when that happened. There was some relief when the president said he wasn't going to do it, but certainly moving markets, and we'll see what happens. There's really just less than a year for Jay Powell's tenure, so we're going to talk to Stuart Paul about that.
Less than a year for his tenure as Fed chair.
As Fed chair, yes.
For Fed governorship, I'm sure we'll discuss that too.
We certainly will. As I mentioned, we are awaiting the Beige Book to drop. This is the anecdotal information that we get from the different parts of the Federal Reserve System, the different areas of the Federal Reserve System. We often look at that for different anecdotes about what's happening in the economy. We're going to be joined in just a minute by our Bloomberg Economics U.S. economist, Stuart Paul. He's standing by. He's going to give us everything we need to know about the Beige Book and give us all things Federal Reserve. We're also going to hear from Mike McKee a little later in the hour. And Katie, I don't think I reintroduced you to everybody.
No.
You don't need an introduction, but Katie Greifeld is in for Carol Masser this afternoon. She is, of course, of Bloomberg News and Bloomberg Television. You catch her on Open Interest every day on Bloomberg TV. Speaking of Bloomberg TV, a little later, we're going to hear from Brian Moynihan. He's sitting down with David Weston. This on a record quarter for Bank of America when it comes to trading.
Absolutely looking forward to that. We're in the thick of bank earnings. It seems like trading revenue has been popping off, especially for Goldman Sachs. It'll be interesting to get the readout from the C-suite at Bank of America as well. Looks like we're getting a little bit of trickling headlines from that Beige Book. Apparently, activity increased slightly from May to July. This, of course, coming from the Beige Book survey of U.S. economic conditions.
Okay. Stuart Paul is a Bloomberg News U.S. economist. He joins us here in the Bloomberg Business Week studio. Stuart, we're going to wait for more of these headlines to come in. And, you know, we were planning to talk to you when we booked you about the Beige Book. But I want to start with everything happening in Washington, D.C. when it comes to the Federal Reserve, because we got a bit of mixed information from different sources about the fate of Jay Powell. We saw markets react, of course, as potentially they would react if he were to step down or be forced out of that role. From an economics perspective, how do you look at what's happening to Fed Chair Jay Powell?
Well, it's unfortunate because, as we know, there is no such thing as a free lunch, but the closest thing that we have to a free lunch in economics is a politically independent central bank. Going back to research from the late 1980s by Larry Summers, friend of Bloomberg TV, we know that independent central banks tend to deliver lower, more stable inflation with very little cost in terms of foregone GDP growth. Speaking of GDP growth, as Katie mentioned from the Beige Book, reading from the PDF here, economic activity increased slightly from late May through early June. Now, when we break it down and look at the 12 different Federal Reserve districts, 5 reported slight or modest gains, 5 had flat activity, and the remaining 2 districts noted modest declines in activity. Rotating to the labor market, employment increased very slightly overall. Now, something to keep in mind is that when we're digesting labor market data, some folks might have breathed a sigh of relief because the unemployment rate ticked down. But as we're hearing from this soft data, employment's increasing just very slightly. And it's concentrated in just a few districts. Part of the reason the unemployment rate is ticking down is because there's relatively less labor supply. So we're starting to see some of the details of the hard data matching up with the somewhat softer soft data that we're getting from the Beige Book right now.
Exactly. That's why we like to look at the Beige Book for that anecdata, for that color, helps to fill in some of the hard data here. I just want to talk about Jerome Powell a little bit more because you read into what President Trump told reporters on Wednesday. He said, no, we're not planning on doing anything. I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. So we know that there's been a kerfuffle over the renovations with the Federal Reserve. It feels like perhaps the president is leaving that door open.
It does look that way. The thing to keep in mind, though, I think, is that a lot of the discussion about renovations, a lot of this idea about fraud is really just red herring. It's an attempt to find a cause that gives the president the statutory authority to remove the Fed chairman from office. What he really wants is lower interest rates. What he really wants is lower debt service costs. But the thing is, if he were to attempt to remove the Fed chairman, markets would start to feel that acid reflux. They would start, as we saw with interest rates, 10-year selling off on this, temporary news, the flash headlines that the president was considering firing Powell. It's very likely, actually, the case that if the Fed chairman were to be fired so that he could be replaced with someone to deliver the president's preferred lower interest rates, debt servicing costs would actually rise as the term structure steepens. It's the exact opposite of what he says he wants.
Well, let's take a listen to what President Trump said earlier today. This was in the Oval Office. We were airing it live. He was along with Crown Prince and Prime Minister of the Kingdom of Bahrain. This is on Fed Chair Jay Powell.
He's not doing the right job. We should be saving $1 trillion a year in interest, when he talks about costs. We should be saving, think of it, $1 trillion a year. Add that with the tariffs and everything else. But he just doesn't want, he's a knucklehead.
The president calling the Fed chair a knucklehead. We should remind everybody that the president was the person during his first term who nominated Fed Chair Jay Powell for his first term. He was then reappointed and confirmed during President Biden's administration. What do you make of that $1 trillion figure? Is that on your radar at all?
Well, it's just completely off. It's if you were to install a Fed chairman who has the objective, the stated objective of essentially monetizing the national debt, as it sounds like the president wants to do, as he calls the current Fed chairman a numbskull or a knucklehead or a total stiff, as that happens, bond investors need to account for additional inflation compensation, higher average expected inflation rates over the entire rest of the term structure. So you would see maybe some rate cuts additionally priced in. You might even see lower 2-year bond yields. But if you think it was a little bit jarring to see the 30-year breach 5% just yesterday, now 5.06 or wherever it is, we would definitely see the 10-year shooting back up above 5%. So you would see just a total rejection of that idea. The actual debt servicing costs would not come down by any trillions of dollars.
Could you build a case for cutting rates here, though? You think about inflation. We got CPI yesterday. That was exactly in line. You got PPI this morning, unchanged on the monthly figure. We haven't quite seen the labor market weakness, but there have been some anecdata to suggest that maybe that's coming down the pike. I mean, you add it all together, could you build that case?
I think that the simplest case for cutting rates right now is that basically rates are currently where they were when we had nominal GDP growth of about 6 to 7%. Right, nominal GDP growth being the dollar value of the economic activity in a year. And currently we're running at a nominal GDP growth rate of about half that, the bulk of which is inflation. So should rates be as restrictive when there was twice as much economic activity and growth in economic activity? And frankly, you would get people on the committee, including folks like Chris Waller and Mickey Bowman, who'd say, no, we could start delivering rate cuts perhaps as soon as July. But when you see anecdata from the Beige Book today, where the most pervasive and the most concentrated set of answers in that anecdata is that around the country, you're seeing relatively hot price increases. You're seeing 7 of the 12 Federal Reserve districts saying price growth is at least moderate, 5 saying it's modest, mostly similar to the previous report. It's not like we're seeing any softening of price pressures. You still have those pipeline price pressures.
We're not seeing softening, but we're not seeing the price pressures go up or prices go up like many economists thought 3 months ago they would as a result of tariffs. Why is that?
So we're starting to see some offsets, right? So some softening of shelter costs, you see some drag from airfares, but the things that are touched most acutely and most precisely by tariffs, things like appliances, home furnishings, clothing, those are seeing rising, in fact, accelerating prices.
Is that because they're a smaller part of our economy? We're a services economy, so we're not necessarily seeing the impact of these increase of prices of goods in the headline numbers?
That's part of it. But the Fed is still looking to prevent inflation expectations from becoming unanchored. A lot of the goods are things that we interact with very regularly. We interact with the grocery store very regularly. It's a notable development when you have to replace an appliance and you realize it's going to cost twice as much as you expected. Those are things that weigh heavily on Americans. So even though it's the case that, yes, rent accounts for a larger share of their total spend than something like appliances, a lot of the time your rent is just deducted from your checking account. It resets every couple years when you sign a new lease. For homeowners, it's the sort of thing that's very stable over a 30-year mortgage. So when inflation expectations are part of the game for the Federal Reserve when it comes to setting rates, they are going to be paying more attention to goods than one might suspect.
And I mean, to that point, something I always wonder is how interest rate sensitive this economy truly is. Because you think about buying a home, mortgage rates, okay, you interact with that not too often. Car payments, maybe you interact with that a little bit more. But one of the explanations for why we weren't seeing, inflation or activity or spending cool down when we had such high rates, and I suppose we still do on a relative basis, is basically that this economy isn't as sensitive as it was to interest rates. Does that argument hold water with you?
That still does hold. So yes, the U.S. economy is relatively insulated from the effects of higher rates. And part of that is because homeowners locked in mortgage rates that were below 4%. So it's still the average mortgage rate on all mortgages that are outstanding in the U.S. economy is just a touch above 4% right now. Nothing even close to the mortgage rates, around 7% that are offered for new mortgages. So the transmission of monetary policy into the real economy is relatively slow. But with home price appreciation slowing pretty dramatically, we expect just full year growth of about 1% for home prices. You will start to see more material slowing in rents, in owners' equivalents of rents, and you also are starting to see softening auto prices, which is a consequence of persistently higher auto loan rates.
And Tim, you mentioned that I anchor this show in the morning. It's called Open Interest. I've already spoken to Stu today. The conversation we were having, though, was about Kevin Hassett versus Kevin Warsh when it comes to the Fed chair replacement. We've been talking so much about Kevin Warsh, but there's another Kevin in the race, according to our reporting, and that is Kevin Hassett. So just give us the overview here. What do we know about Kevin Hassett, what his stance is, and how that might translate into a Fed chair, Kevin Hassett?
Kevin Hassett has been a very vocal supporter of the president. He's been a reliable alternative voice coming from the administration, making the rounds on Sunday shows. Most of his experience, though, is more so in tax policy, which is why it was useful to have him in the White House, helping to shepherd across the one big beautiful bill. He's a little bit more difficult to read in the context of monetary policy. Kevin Warsh has his experience as a member of the Board of Governors during the George W. Bush administration, and so it should be easier to get a read on him. What's difficult, though, and why it's a little bit tough to say what we'd expect from an outsider at this point, now 20 years basically removed from the job as Kevin Warsh is that he was very critical of the Federal Reserve for maintaining especially low interest rates from the global financial crisis through basically 2018. He was very critical. But he's basically interviewing for a job where he's going to be asked to cut rates into an economic expansion. And so there's a little bit of intellectual inconsistency between his criticism of the Fed as an institution and the job that he's interviewing for. So I think to sort of square the circle between candidates, Kevin Hassett might be someone who's easier to put into that role, but I don't think that it's necessarily a mortal lock that he would be an easy confirmation in the Senate. He's someone who's been very critical of the Fed and its forecasting failures. Right. But this is someone who published Dow 36,000 on the eve of the bursting of the tech bubble. And so he would certainly come under fire for his own forecasting failures 25 years ago.
Well, we did hit Dow 36,000 a few years ago, so he ended up being right. Just
very early.
A couple decades. Couple decades of timing. Stuart Paul, U.S. economist for Bloomberg Economics on the economy and all things Fed Chair Jay Powell. I want to bring in Gina Martin-Adams. She's Chief Equity Strategist for Bloomberg Intelligence. She joins us here in the Bloomberg Business Week studio. You're watching the market reaction to everything happening out of Washington. We saw stocks fall, and then they kind of bounced back to where they were before this message from the president a little earlier. What would happen to the equity market if Jay Powell were somehow fired or forced out?
Well, I think it is pretty destabilizing, as we did see when the rumors were flying that today might be the day. Once again, the equity market had a bit of a hiccup. So I do think it's pretty destabilizing. Ultimately, the equity market in these instances largely takes its cues from what's happening in the bond market as well as currencies. So I think the dollar is extremely important to watch right now. The dollar is still down, even with a little bit of a recovery post-news event where Trump sort of walked back any kind of concerns that he was going to fire Powell immediately. I think there's a bigger risk at play here that the dollar may be signaling, and that is maybe Trump doesn't fire him, but it actually goes through the process with Congress, and ultimately he gets fired that way.
But
that's
I mean,
a
but
possibility
he's out
as well.
in May anyway, so
I know.
at least out of as Fed chair,
Yes, thank you.
not
Thank
off the
you.
Federal Reserve.
Yeah.
But
Yeah.
I know. I completely sympathize and understand that, but nonetheless, there does seem to be some urgency on the part of this administration to want to make this happen one way or another. So I think you watch the broader markets, the macro signals are pretty important for stocks. In the meantime, stocks are in the midst of the earnings season. So
Right.
they're obviously going to focus predominantly on the signals from companies. And then to the degree that this is impactful, it impacts stocks through those other asset prices that do have an impact on valuations.
Well, just to point on what we saw, the market reaction to some of those headlines, Anna Wong over at Bloomberg Economics writing, we think Trump is testing the waters to see whether he can fire Powell. The sharp market reaction appears to have convinced him to pull back on the firing rhetoric for now. So we'll watch that space. But when it comes to earnings, let's talk a little bit about what we saw so far. It's mainly been the big banks, but the reaction to Wells Fargo yesterday, I believe they cut their guidance, to BlackRock missing their estimates when it came to inflows, it was punishing.
Yes.
And you think about the sentiment in the market right now, is that what we should expect, that misses will be much more punished than maybe they have been?
Yeah, and I think you said the key term, and that is guidance. So misses to the outlook are especially important because the market is priced to assume a beat to the current, right? And this is really tricky because the consensus was so low coming into this earnings season that it's inevitable that these companies are going to beat extremely low expectations from the sell-side consensus. Yet at the same time, financials on a relative price to book basis are trading at their peak levels in the last 5 years. So very, very expensive stocks relative to the recent past anyway, contrast with very low expectations. What that means is the market expectation is very different than the analyst community expectation. And the market expectation is really about the future. It's about a much greater return of capital to shareholders likely to come from this group. It's about deregulation, ultimately removing the so-called shackles of the financial sector, allowing for faster growth. So to the degree that any of those assumptions are questioned, that creates the risk. It's about the future. Are we going to actually sustain these new assumptions for much faster growth coming out of financials or not?
Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence, joining us here in the Bloomberg Business Week studio. Gina mentioning banks, talking about banks. Coming up next, an interview with Bank of America Chairman and CEO Brian Moynihan. That's next on Bloomberg Business Week Daily.
2:21 on Wall Street. We do check markets all day long here. Bloomberg has been a volatile trading session. Right now we have got the Dow, the S&P, NASDAQ. They are all advancing. All eyes on Washington. Bloomberg Television and Radio. We got you covered. President Trump denying that he is seeking to remove Fed Chair Jay Powell, saying to reporters this morning, quote, "No, we're not planning on doing anything." Stocks initially sold off, rebounded. Right now we have got the Dow, the S&P, NASDAQ in the green. Should point out that the NASDAQ 100 index does, however, remain lower. So here's where we stand. S&P up 8 right now, 62.51. At one point this morning, we saw the S&P dip to as low as 62.01. You'll recall that yesterday, trading at a record 6,300 on the S&P. Right now, up 0.1%. The Dow up 115, up 0.3%. NASDAQ up 14 for the NASDAQ Composite Index, a gain of 0.1%. 10-year 4.45%. The 2-year 3.88%. Gold up $30 the ounce, higher by 0.9%. And West Texas Intermediate crude down 0.1%, 66.41 for a barrel of WTI. Bank of America shares trading lower after earnings, down now by 0.7%. Coming up 2:30 p.m. Wall Street time, our David Weston will be sitting down with Bank of America CEO Brian Moynihan. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie. Do appreciate it. Well, the second batch of big banks reported earnings today. There was a theme: market volatility sparked by the trade war, leading to record quarters for traders. Goldman stock traders posted the largest revenue haul in Wall Street history. Morgan Stanley stock traders scored their best second quarter on record. And Bank of America traders also posted a record second quarter. Watching all of this closely, Ken Leon, Director of Equity Research at CFRA Research. He joins us from Florida. So record quarters for trading across the board today, yet the stock reaction to the downside. Why is that?
Well, it's great to be here. And when you look at the global U.S. banks, they performed very strongly. What we did see was not only trading, but the elevated markets means that fee income across many different businesses like asset management, wealth management, other services generated substantial year-over-year growth. What we are also seeing is how the capital markets can be the delta for getting stronger growth, and also higher estimates expected from the street looking ahead, both for revenue and earnings. Those that are more balanced or exposed to Main Street America, consumer and small business, are likely to see much slower growth and some risk of kind of sluggish demand in the future. I think that's really the difference between the outsized significant performance of Goldman Sachs, strong growth for Morgan Stanley, and then those that were kind of in between were the JP Morgans and then Bank of America, which didn't fire on all cylinders. That's the difference.
But Ken, still, I mean, when zooming out from just today's action, even though, I mean, Goldman only being up 0.5% after posting a record quarter when it comes to trading, what is the driver of these financial shares? Is it the yield curve? Is it actually the numbers that we get in the earnings report? Is it something else? Because I feel like I go through this puzzle at least 4 times a year when we get these earnings.
Yeah, lucky for you, 4 times. For me, it's every day. And we've been overweighted the financial sector really since last November. And the large banks are, in the top 10 of that sector. And what we've seen even in the second quarter or year to date is tremendous performance, more than 2 times the S&P 500 for diversified banks. But that's not the point. The key point is, where do they go from here? We think the delta, not only for the rest of this year, but really these stocks are going to be priced on 2026 earnings, is going to be how they do into next year. Obviously, 2 to 4 rate cuts, some easing on the regulatory framework, and then also some opening up in the capital markets for investment banking. That's going to help these banks. When you look at them, in terms of PE multiples or what Gina was talking about, the overall market, they have to earn into these valuations or multiples. when we look at more conservative metrics, which a lot of bank analysts look at, because they're a conservative lot, such as price to net tangible book value, they're pretty expensive. But I think it's earnings growth and what that does in terms of confidence that they can still have upside over the next year or two. That's the key.
Ken, I'd be remiss if we didn't ask you about the drama with regard to Fed Chair Jay Powell. The reports emerging early today that he would be fired by the president, and the president was seriously considering doing that. We saw a market reaction from the equity side and from the fixed income side. And then just a little later in the morning, we heard from the president, who denied that he would do that imminently. Yet there are certainly concerns about the way that the president feels about the Fed chair. We all know that. What would it mean for banks if this were to happen? Would it mean anything?
So I'm a global director, and I look at markets all over the world. And also when you look at the bond market and really the 10 and 30-year treasury, the Fed really matters. Its independence, the respect and responsibility of its two mandates for inflation and full employment. I just think this is color or drama. Jay Powell is highly regarded. And the other issue, of course, is when his term is up next year, likely probably to retire, but he could stay on for a few more years as a governor.
Okay, so what would happen, though, if he were forced out?
I don't see that scenario.
You really don't?
But at the end of the day,
even if they were to find some potential, look, the president has targeted the handling of the Fed renovation. What if there's something there and he can push him out through that?
So President Trump's going to get a dovish Fed chairman in part. Nobody's really hawkish today. The data will suggest possibly a slower U.S. economy rest of this year, which is why we're much more positive on the delta of the capital markets, not Main Street America, to help large banks' earnings. So we're just going to have to see. But, overall, Fed's going to be independent. And, of course, we're going to get rate cuts either way.
I have a thought as to what would happen to the banks if Jerome Powell were forced out. You would see a lot of volatility, and the banks would probably trade it, Ken. And that brings me back to all of these trading records that we saw, at least for Goldman, and then these bumper quarters that the other big banks put up. Of course, we know what happened in April. We had Liberation Day at the start of the month, and then we had the walk back. And it seems like that was a big boost for these banks. And the question that comes about is, how sustainable is that? When you think about all of this revenue that's being made in training, how sustainable is that?
It's not the trading. You really need to focus on financial sponsors, which are the large private equity firms. They're sitting on $2 trillion of companies they own, they have to monetize in some way, and also afford the investment bankers to get that job done. That's where I would really look as a delta that we haven't seen really in the numbers and size as it relates to mergers and acquisitions, equity underwriting, or other forms of transactions. Look to lower rates, making it more appealing to valuation for both public and private transactions. That's going to be a bonanza for the large banks.
Ken Leon, Director of Equity Research at CFRA. Thanks so much, Ken. Good to see you this afternoon. As we mentioned, Bank of America traders posted a record second quarter as the company reaped the benefits of volatile markets and net interest income top analyst estimates. For more, we sent things on over to David Weston. He's standing by with Bank of America Chair and CEO Brian Moynihan. Hey, David.
Thanks so much, Tim. For our Bloomberg audiences worldwide, this is Bloomberg. I'm David Weston, and this is Brian Moynihan, who is the Chair CEO of Bank of America. Brian, thank you so much for being back with us. Really appreciate it on this busy day for you.
Oh, it's great to be here, David. Good to see you again.
So let me start with one of the favorite questions I have for you, because you at Bank of America have a window into so much of America, consumers and businesses of all sizes. You sort of have a sense of where the pulse of America is. There's been a lot of changes announced and talked about in Washington. Do you see from your customers much reaction to that, either to the talk of tariffs or the one big beautiful bill? Do consumers or businesses, are they changing their plans because of that?
So if you look on the consumer side, in our 70 million consumers who engage with the economy every day, and they send through their accounts and spend the cash and everything, about $5 trillion a year. That grew at 4% plus the second quarter 25 or the second quarter 24. So they, because they're employed and because wage growth, and that's not every single consumer, but in the large, in the main, they are continuing to grow and spend more, and that helps the economy. And so you're seeing in some of the moderate income households, there's a little bit of moving around to different things. You're seeing people trade from one thing to another, less planes, more cruises earlier. That's leveling out now. A lot more going to movies because the movies are good. But at the end of the day, they're spending discretionary necessary at about the same percentage they traditionally have spent. They've got money in their accounts. They're employed, and the wage growth has been relatively strong, and so they're in pretty good shape. The credit quality is good. They have equity in their homes. They're low rate financing and mortgage, so consumers pretty good. When you go to small businesses, that's more the question, small, medium-sized businesses, because the interest rate environment hits them harder because they borrow on lines of credit short-term for a lot of their activities, and that rate went up substantially. And then you think about if I'm a $100 million company, a $50 million company here in North Carolina, and I'm engaging in the world finance, I'm importing goods and manufacturing them, further manufacturing them, selling them. It got pretty interesting here trying to figure out all the trade and tariffs. So I think the certainty on the tax rate helps them. Meaning the big, beautiful bill passing and the tax rate, that's a very good thing. The alternative would not have been good if their tax rates would have changed. A satisfactory resolution to the trade so that they can learn the rules of the road over the next 30, 60, 90 days and get their plans for next year put together. And I think ultimately we're going to have to satisfactory resolution on immigration and population growth, because at the end of the day, what I'm hearing more from construction companies, farming companies, and travel and entertainment type companies is I'm starting to worry about, I'm starting to struggle with labor availability at any price. And that's not, that we got to make sure they have the workers, because they will supply a great service economy will continue to grow.
One of the things you reported today was net interest income, which is really important to all banks, but particularly Bank of America, and just steady growth that you're showing in that. How sensitive are you to the rates set by the Fed? If that comes down substantially, does that affect Bank of America much?
So embedded in our estimates, so we've told the world that this quarter we had $14.8 billion in net interest income. And that is the fourth straight quarter of growth, and came off the floor last year. This quarter, when I was talking to you, was the lowest it's been. This quarter was a record in the company's history. And we're saying we're going to grow from that record to 15.5 to 15.7 in 2 more quarters, the third quarter and the fourth quarter. That embeds in it the rate cuts in the market that are expected by the market. We only show it that way. If you have rate cuts above that, that would hurt that number, but it would still grow, frankly. And so, the good thing about that is because of great loan and deposit growth, 7% loan growth, 4% deposit growth over the last year, that's in the system. That's capitalized in. I mean, that's here. It doesn't go away. And as that continues to stay and we add to it, what you're starting to see is that sets us up great for next year for further NII growth and further EPS growth. So this quarter was the trickiest quarter to get through, because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth is a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
When you talk about 2026, one of the things we're going to have is, in all likelihood, a new Fed chair. There's been a lot of talk, even today in Washington, about the Fed chair. And you've said you believe in an independent Fed. But if, in fact, President Trump gets his wish, as is his right under law, to appoint a new chair who will be more in line with his views, he said he thinks the interest rate really should be at 1% or even below that. Is that good for Bank of America? Is that good for the economy?
Well, let me make 2 things. One is, you're absolutely right. In May of next year, the term of the current Fed chair ends after being reappointed, and it's the right of the elected president to appoint the next successor and go through Congress. And I think in that dialogue around that, there'll be a lot of dialogue about, okay, how do you set interest rates? What do you think about interest rates? Because the Fed is an independent agency, and they're meant to be outside the purview of the executive and the Congress. They are called to task, and they're monitored, and they're reviewed, and all the things. But the reality was set up to be independent, so that our central bank in America was independent. So I think no matter who gets in, they're going to look at it and have to look at the facts and make a decision, because if you drop rates too far, inflation may kick up, and then you're going to have to raise them back quickly. On the other hand, if you think the prior Fed has been slow to lower rates, you might lower them faster. Our team believes that the Fed will lower rates in the second half of next year by 100 basis points. No change until then, because inflation is still going through the system. That brings the Fed funds rate down closer to 3, which they think is probably more of a long-term rate, and frankly is more similar to what we had for most of American history. What's been unusual is the period after global financial crisis, a very low interest rate structure. That is really not a good place to be, honestly. We'd rather have a higher interest rate structure, a little more inflation, a little more robust economic growth. So I think everybody has to be a little careful about keeping that engine going, because if this engine fails, the whole world fails.
You also reported increased loans from Bank of America, which is good news for you. Tell us about your competition for that. We now have private credit really coming into that area substantially. There's talk that maybe that would be peaking. Is that the way you see it?
Well, I think that, so if you think about all our loans, $1.1 trillion of loans, say half from the consumer, and so there's not, that competition's always been there. Half of what goes on for consumer lending goes on outside the regulated banking industry. That's been true for a long period of time. We saw growth across all the segments. We feel very good about that. We go to commercial, the private credit affects sort of the leverage finance and some of the areas, and it's been an effective competitor. It's grown. I think we in the industry and we in the company, Bank of America, have come back with a way of operating we think is consistent with our credit quality, consistent with who our customers, and will also deliver a competitive product. And we grew commercial loans, leave aside the market-based business, we grew commercial loans, I think 7-8%, excluding the CRE office that we are running down still, in the middle market, which is as strong as anybody, and we feel very good about the credit quality of those loans. But more importantly, we feel good about the 30, 50, 70-year corporate relationships we have, and if they want a different kind of financing, we'll bring it and take it to the market for them like we've always done.
You also had a great quarter in terms of trading. Give us a sense about where you're going with your trading activities and your investment bank. In the past, you've added more balance sheet strength to that. You've come up in that. Do you plan to keep doing more of that?
Yeah, and so Jim DeMar and the global markets business, which is the trading business, as you call it, they are up 15% year over year. Both fixed income and equities were up. And he has had 13 straight quarters, I think it is, of year-over-year quarterly comparison growth. And so there's some ebb and flows in that business. But this quarter started off a little interesting with Liberation Day, and I think the first 4 of the biggest days ever in equity stock trading occurred in the first week of April or something like that. So it was a pretty wild time. But over the course of the quarter, it got more stable, and they made it. We have given him more capital and more balance sheet, him and the team, more importantly. And that team, under his guidance, has delivered on it, is getting a good return on it. And we have lots of capital. If he can put it to work, there'll be more of it. The trick is he's also got to use it efficiently and get that return on tangible common equity, return on allocated capital straight. When you go to investment banking, look, April was kind of quiet, especially on the M&A side for us. It came back, and you saw us, as recently as 3 or 4 weeks ago, we thought we'd do $1.2 billion. We did $1.4 billion, and with pipelines full, Matthew Coder and the team are out there driving at it. We lost some deals to other people in the M&A. We were on the wrong side of the trade. That happens. But the reality is, what really changed over the course of the months was the financing side kicked in, and that's 3/4 of our revenue, and that was good, and that's why the revenue came up. And that team does a good job, and there's lots of places to grow. That is going to be much more dependent upon the IPO markets being open, the M&A markets, the M&A taking place. And I think with stability, again, back to the tax bill, some trade stability, and then, frankly, deregulation, you're going to see, I think, that activity keep kicking in as we move through 2025 and 26, which will be good for the economy because it creates a lot of activity, investment, changes in businesses, and all those things that we expect to see.
You took time out from your earnings announcement to really focus on artificial intelligence, something you have been talking about for quite some time and adopting, for example, with Erica that you have. Give us a sense of how that's changing the business at Bank of America, for example, on the expense side. Does it really lead to saving some costs?
So in the end of the day, the artificial intelligence, as we know it, is an extension of a series of technology capabilities that allow us to take work and have machines do the work, and people and enhance the people's ability to do more work and do more things and spend more time on things that aren't capable of going through that. AI just gives you a different sort of a different attack surface, for lack of a better term. In the past, we had 300,000 people 15 years ago in our company. Today, we have 212,000 people. The company's bigger, complex, more transactions. From that time, our digital logins were probably, 10, 20 million a quarter, and we felt good about it. They were several billion, they're a billion a month, just to give you a sense. So think of all the investment to do that. But that digitization was customers doing things on their own at 10 o'clock at night and 7 o'clock in the morning, and that allowed us to save our time for our people to go out and help customers solve difficult problems. What AI, the place that we think AI has real help is in the preparation of our relationship management force and our small business bankers, our business bankers, our commercial bankers, our wealth management, our investment bankers, allows them to be much more prepared. So we're using those tools to prepare the information, pull it together, because it can take text and manipulate it and put it into the forms and the capabilities. So that's a big thing in front of us. We've done 500 or 700 pitches so far, and that cranking up. We see it in employee self-help. If you had a computer that went down at Bank of America, you can click on Erica for employees, and a chatbot will take you all the way through the replacement of your computer process, and it will involve no people, and you'll get the computer delivered to you. So, that's how we took that same Erica model that 20 million consumers use 200 million times a quarter and turned it internal. And so there's all these applications, and we think it has high application for the services business that Bank of America's in, and the ability to keep doing work. And in the end of the day, we'll have teammates who will harness it and take it and use it to their advantage to make themselves even more successful. So, when we talk to teammates, we say, embrace this, let's drive it, and then let's figure out, what job you're going to do, but you're going to need this to be able to do any job in this company.
As you move forward with artificial intelligence, is it changing what you're looking for in the people coming in the door, the entry-level people?
No, we're just in the process of bringing in our 2,000 plus kids, new hires that just started, I think, this week. So think about that. 2,000 kids arrive. 1% of applications, less than 1% were accepted. So we had 190,000 applications and around 2,000 people coming in. So we're getting the best of the brightest. We love them. They're coming in. The point I'm making is there is a group that has to use computer skills and data skills, and that's one set of things. But everybody has to be able to use AI to help them be a better employee at Bank of America. So as you think about that, every teammate, and I have high confidence kids coming out of colleges are going to be a lot better AI than you and I might be, David, but we'll catch up to them someday.
One last question, Brian. You've said that you're moving towards stablecoin, as some other banks are as well. You saw Mr. Bailey, who's the governor of the Bank of England, really said that might have systemic risks because it takes some of the money out of the banking system. You'd be better off going a different direction. Are you worried about systemic risks from stablecoin?
So one of the questions, and I think what Mr. Bailey was talking about, is a question I think the banking system, the United States, the policymakers have to think about, which is, think about the money market mutual fund. About $6 trillion of deposit banks moved to money market mutual funds, and their utility was to invest in short-term, deposits, treasury bonds, et cetera, commercial paper. They can't invest long-term, so their ability to help the economy is really a limited amount. That $6 trillion is outside the system. If you said we're going to take the $18 trillion or whatever is in the banking system today, another $6 trillion out, you'd have to think through the policy ramifications, because to keep it stable, you have to have it invested in a very narrow place. And I think that's what Mr. Bailey was talking about. I think that dialogue is going on now. There's another side of this, which means those deposits will come back in the system if we hold the deposits effectively in escrow or custody for our customers who are out engaging stablecoins. So I think there's a lot of turns in the track between where we are today and where we might be on this. Our view is pretty simple. 10 years ago, you would have said the clients don't need a thing called Zelle, and now they use it twice as much as they use checks, and it is used more times than the amount of checks written by our consumers and the amount of cash transactions taken cash out of the M. So it's become the dominant payment network for consumers outside of card. That didn't exist 10 years ago. So we got to have the consumers adopt this. If they want it, we'll build it, and they'll use it. And if it's a way to transact, we'll be there to help them transact. We think, small balance cross-border transfers, in-app sort of manipulation purchases, all these types of things are applications for. But at the end of the day, it's our customer who needs to say, I want to move money. I want to move money into euros. I want to move money into stablecoin. Sort of, we got to be able to do both for them.
Brian, great pleasure to talk to you. Thanks again on a busy day for joining us. That is Brian Moynihan. He is Chairman and CEO of Bank of America. And now back to you.
Thanks so much. That, of course, is David Weston of Bloomberg Wall Street Week. Catch new episodes every Friday at 6 p.m. Wall Street time on Bloomberg Radio and Television. Also, a big thank you, of course, to Brian Moynihan for joining us there as well. Few headlines from that interview. Brian Moynihan saying it is the president's right to pick the next Fed chair. David Weston, of course, asked him about everything happening in Washington with regard to Jay Powell.
He also said on the topic that an independent Fed is critical to the U.S. and that a stable and independent Fed is key. Of course, they also spoke a little bit about Bank of America's results, their second quarter trading revenue beat estimates. But you made the point to me while we were listening to that interview and watching the headlines roll in. It's the president's right to pick the next Fed chair. He did pick this one specifically, though.
He did, yeah. Back in his first term, he picked Jay Powell. Then he was reappointed, of course, by President Biden during President Biden's term and confirmed by Congress. Bank of America shares, by the way, they are down about 0.5 percentage point right now. Let's get on over to Charlie Pellet, who's standing by. We got about an hour and 14 minutes to the close of equity trading, but Charlie, who's counting?
Well, we are, because that's what we do here at Bloomberg. We got you covered on the closing bell, Bloomberg Radio and Television, and of course, all those fast-moving developments today that move markets out of Washington, D.C. Lower right around 11 o'clock with the S&P falling to just about 62.01. You'll recall yesterday, the S&P was at a record 6,300 briefly. Here's where we stand right now with the S&P up 14, 62.57. That is a gain of just about 0.2%. The Dow up 165, up 0.4%. NASDAQ, the composite index, up 31, up by about 0.1%. The NASDAQ 100 index calling that flat on the day right now. The 10-year 4.45%, the 2-year 3.87%. Gold up 0.8%, 33.52 the ounce. To be clear, 33.52 the ounce. And West Texas Intermediate crude flat on the day, 66.50 on WTI. Speculation about the fate of Fed Chair Jay Powell setting off a short-lived tempest in financial markets, with volatility mostly quelled after President Trump said he has no plans to fire the central bank chief and was discussing it only in concept. United Airlines reports after the close of trading. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Do appreciate it. Well, as Charlie mentioned, we're watching everything happening out of Washington when it comes to Fed Chair Jay Powell. President Trump denied that he is seeking to remove Fed Chair Jay Powell after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media. I want to bring in Michael McKee. He's Bloomberg News International Economics and Policy Correspondent. He joins us from Victor, Idaho, where he is for the Rocky Mountain Economic Summit. And Mike, I take it there's a lot being talked about among the Federal Reserve bankers who are there, among the pundits who are there. What is the conversation happening in the wake of everything we heard this morning from the president and from reports before the president spoke?
Well, actually, Tim, there's a bit of an eye roll going on with a lot of people because we've been through this so many times with Donald Trump, and the whole idea of taco came up again. So nobody was surprised when he came out and denied the earlier reports that he was ready to fire the president, perhaps as early, fire the Fed chair, perhaps as early as today. But the general feeling has been, and we talked about this a lot at dinner last night, that the president won't do it because it doesn't get him very far. It would probably, as we saw this morning, lead to a steepening of the yield curve, a widening of spreads, the dollar falling, and interest rates would go up rather than down in the markets, and it would just create a lot of confusion and hurt the Fed's credibility. It would also end up in court. So he might try to remove the Fed chair, but it would take many months of legal maneuvering to get that far. And really, Powell doesn't have that much longer to go as chair.
You said that there was a little bit of eye rolling because this is sort of a movie that we've seen before. Let's take a listen to the rhetoric from the president just over the last few months when it comes to the chair of the Federal Reserve.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job.
Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
That was President Trump over the last few months, his rhetoric around Fed Chair Jay Powell. It's in chronological order, and I want to point people to the part just before the last soundbite where he said he's spending $2.5 billion rebuilding the Fed. Mike, is there any there with this new line of attack when it comes to this renovation?
Well, there are questions about why the renovation has gone up from 1.7 billion to 2.5 billion. And I suppose those are things that could be investigated, and Powell has asked the Fed's Inspector General to look into it. The Fed's response so far has been that these plans were approved in 2021, and obviously right after that we had a big inflation, and so the costs of everything have gone up. They have also argued that a lot of things that the administration is focused on, or some of the administration officials who tweeted about it are focused on, are things that are actually not in the final plans. And so it doesn't appear that there's a lot there. Is it enough for cause to fire a Fed governor? That would be up for the courts to decide. And as I said, that would take some time. So I don't know that that's a big deal. In that string of Trump quotes, I would also point to the one where Trump said, "I was surprised he was appointed." Well, Trump appointed him as chair.
Yeah,
good reminder.
Tim is eager to make that point. He did also express surprise that Biden renominated him, President Biden. I do want to get your thoughts, Mike McKee, on the idea that, okay, his term as Fed chair ends in May 2026. We know that. We also know that his term as Fed governor doesn't end until January 2028. We had Treasury Secretary Scott Bessent join Bloomberg Television yesterday, and he said that would be very confusing for markets if Powell did stay on as a governor until January 2028. What does the precedent look like there?
Well, there really isn't a precedent. The closest you can get is back in 1951, the Treasury-Fed Accord, where the Treasury Department and the Fed agreed that Treasury would handle fiscal policy and the Fed would handle monetary policy. And the Fed chairman at the time stepped down. President Truman appointed a new chair, but the old chair stayed on for a couple of years as a governor. But it wasn't a matter of standing up to the administration at the time. He was actually asked to do that, to lend his experience. In this case, this would be a completely unusual situation. The only close analogy I could come up with would be Paul Volcker, who faced a rebellion among his fellow board governors, and the Reagan White House told him, "We think this means you need to go." And he did resign, but it was a kind of different situation than we have right now. So this would be, as Scott Bessent said, a completely confusing mess for the markets, particularly if the president appointed someone he's seen as a toady to him that would just try to lower interest rates regardless of economic conditions. The next thing that would happen would be Governor Powell would offer a speech and it would get massive coverage, and the markets would be torn between which ones to believe. It's also, and this is important, Tim and Katie, to realize that the Open Market Committee that sets interest rates selects its own chairman of that committee, and it doesn't have to be the Fed board chairman. So the president could appoint Kevin Hassett as the Fed board chair, and the Open Market Committee could just keep Jay Powell as its chair. And so interest rates wouldn't be any different than they are right now.
All right, Michael McKee, we're going to have to leave it there. Michael McKee, Bloomberg News international economics and policy correspondent. He's out there in Victor, Idaho. Tomorrow, he's going to be speaking to San Francisco Fed President Mary Daly, so be sure to tune in to that. I'm Tim Stenovic, along with Katie Greifeld. Let's take a look at some stocks on the move today. We're joined by Bloomberg News equities reporter Alexandra Semenova. Alex, what's got your attention today?
Hey guys, well, it was a really difficult time for most investors back in April through the tariff volatility, but it was a fantastic time if you were a trader at Goldman Sachs. The firm's equities unit posted its largest trading revenue haul in Wall Street history. Most people thought it would be good, but not this good. Equity trading revenue for the second quarter came in at $4.3 billion. That's $600 million above what Wall Street analysts expected. That also helped push profit expectations for the period, and trading desks across Wall Street benefited from the volatility, but actually surprisingly for the quarter, Morgan Stanley, Bank of America, and JP Morgan's actually slipped a little bit. Goldman has been trying to build out its trading business. It's Wall Street's most profitable, to compete with the likes of Morgan Stanley and market makers like Jane Street and Citadel. And obviously this quarter is a testament that that effort has been successful. The stock is up just a bit today, 0.5%, but it's up 22% this year through yesterday's close.
Yeah, tough crowd, right? When it comes to Goldman, you post a record trading.
And it wasn't enough
quarter.
for investors, I
Not
guess, because
enough.
financials have run up so much this year.
That's true. The bar was high. How about ASML? We were talking, not in this show, but I was talking yesterday about NVIDIA seeming...
We talked about it too.
I'm sure you did. I was home. But anyway, talk to us about ASML, because it's not a blanket good news story for these chip makers.
Right. A company that is not faring too well through all of the tariff uncertainty. Its CEO today walked back his forecast that sales would grow next year, blaming trade disputes and global tensions. Back in October, he actually told investors that 2026 would be a growth year for the semiconductor industry. Not so much anymore. ASML instead took a more cautious stance today when it reported its second quarter earnings. Its chief financial officer said that clients are more worried about the global trade war than they were back in April. He said our customers are more concerned about the tariff discussions today than they were 3 months ago. Countries are in full battle mode. Again, ASML forecasts third quarter net sales between 7.4 billion euros and 7.9 billion euros. That was below the forecast of 8.2 billion. It expects revenue of 15% growth for the next year.
Okay, in the U.S., the ADRs are ASML U.S. down 8.3% right now. Out in Europe, in Amsterdam, down 11.4% on the day. So quite the hit.
Tough day for them.
All right, Johnson & Johnson, a little bit of green there.
Yeah, so interesting how differently these companies have been navigating all of this. Johnson & Johnson, a company that is faring much better. It beat Wall Street quarterly sales expectations and raised its full-year outlook. Obviously, what companies are saying about their outlooks is so important this earnings season. This is also a show of confidence at a time that the pharmaceutical industry faces the threat of tariffs. The strong results from the sector come even as President Trump floated the idea of tariffs on the sector. On Tuesday night, he said that they could probably come at the end of this month, start slowly and work their way up. He actually told reporters he would impose tariffs of as much as 200% on the sector over the next year to 18 months if companies don't move their businesses here to the U.S. And the CFO of Johnson & Johnson actually said that the gradual approach was a good thing. It's a testament that Trump understands that this can't happen overnight. So obviously, investors are taking those remarks positively. Mizuho also said that a notable takeaway is the increase in guidance in the face of so much regulatory and policy uncertainty.
J&J shares up about 6% as we speak. Alex Semenova, she's Bloomberg News Equities reporter. For more conversations like this, check out our new Stock Movers podcast. You can subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Katie Greifeld, you have been here since the wee hours of the morning, so you get to leave.
This was one of the better hours, I have to say.
Oh, it's so nice. It was fun. Come back. Hang out with us again.
Maybe.
On Bloomberg TV, the close is up next. If you're sticking with us on radio, Isabel Lee next.
CBS News on the Hour, sponsored by O'Reilly Auto Parts.
I'm Michael Wallace. President Trump is again attacking Jerome Powell, but says it's highly unlikely he will fire the Fed chairman.
He's always been too late, hence his nickname, Too Late. He should have cut interest rates a long time ago. Europe has cut them 10 times in the short period of time, and we cut them none.
CBS's Ed O'Keefe says Trump was leaning towards canning Powell just hours ago.
In a meeting with House Republican lawmakers last night here at the White House, the president floated the possibility of doing so and seemed to infer that he was planning on trying to remove Powell pretty soon.
Not all Republicans want Powell gone. Here's North Carolina Senator Tom Tillis.
Look, I've had problems with Chair Powell, but at the end of the day, I respect him and I respect the independence of the Fed.
Tillis has announced he will not run for re-election after breaking with President Trump and voting against his big tax and spending bill earlier this month. Federal law says the Fed chair can only be dismissed for cause. The president is again blasting his own supporters who are demanding the release of all the files pertaining to convicted sex offender Jeffrey Epstein.
Attorney General Pam Bondi has sparked criticism with her statements about whether there's a client list in the Jeffrey Epstein case. Bondi's statements essentially signaled the case is closed, and that has sparked backlash, even from some Republicans. President Trump first blames Democrats.
It's started by Democrats.
Then he widens the blame.
It's all been a big hoax. It's perpetrated by the Democrats, and some stupid Republicans and foolish Republicans fall into the net.
The president added the Attorney General can release, as he put it, whatever's credible. Linda Kenyon, CBS News, the White House.
The cause of Sunday's deadly fire at an assisted living facility in Fall River, Massachusetts is still unknown, but Fire Chief Jeffrey Bacon is sure it was accidental. He says the first units on the scene faced tough choices.
A chaotic scene. They describe seeing faces in windows, and having to decide who they need to rescue.
9 people were killed. It was the deadliest fire in Massachusetts in 41 years. 6 firefighters were injured. A key party is leaving Israel's government.
The ultra-Orthodox Shas party says it's quitting Prime Minister Netanyahu's government. Shas has been pushing the coalition government to bring in a bill to grant wide military draft exemptions to its constituents. A second ultra-Orthodox party quit yesterday over the same issue. This leaves Netanyahu weakened but not threatened, as Shas said it won't try to topple the now minority government. Elaine Cobb, CBS News.
Stocks finished the day higher. The Dow up more than 200 points. NASDAQ up 47. This is CBS News. Many Americans with credit card debt feel they'll never get out of it.
That's according to a new online survey from Bankrate.com. Nearly half of those people blamed emergency expenses for their credit card debt. Ted Rossman is an analyst with Bankrate.
We see that almost a quarter of credit card debtors, 23%, believe that they will never get out of credit card debt. That's a troubling statistic.
Rossman says of note, there's been a 7% increase over the past year in the number of Americans being in credit card debt for a year or more. Jim Crisula, CBS News.
The entertainment data company Illuminate says more music is being streamed than ever before. Global streams reached 2.5 trillion in the first half of this year, up from 2.3 trillion last year. Streaming now accounts for 92% of all music consumption. The report says Christian music is seeing a resurgence, as is recession pop. Hits from the Great Recession by artists like Miley Cyrus and Lady Gaga. Michael Wallace, CBS News.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a good afternoon, everyone. It is a Bloomberg Business Week Daily. We are 1 hour away from the closing bell. on this Wednesday, July 16th, 2025. It is Bloomberg Business Week live from the Bloomberg Interactive Brokers studio. We're streaming on YouTube and on Bloomberg Originals. I'm Tim Stenovic, along with Bloomberg News cross-asset reporter Isabel Lee. Welcome. It's good to see you.
I'm very excited. This is the highlight of my week.
Oh, well, don't say that yet. We got 2 hours to go. So if you still say that at 5 o'clock, then that's a good sign. We're really glad to have you. We're going to get an update from markets from Charlie Pellet in just a second on markets. But Isabel, we saw some buying early in the session, then some quick selling after some reports this morning that the president would fire Fed Chair Jay Powell imminently, and then some buying after he denied that. What did you make of that whole kerfuffle?
It's a little, I don't want to say crazy, but it really is, because I feel like markets were testing, or rather the administration was testing markets to see how they would react, and then they got the reaction. We saw a sell-off and the bond 2-year yield steepened, so that's why maybe Trump pulled back. But then we saw markets calm after that, but still, lots of interesting things to watch out for.
Yeah, it's certainly going to be a through line of our questions to our guests and in our conversations this afternoon. Also on our radar, rare earths, a huge week when it comes to investment from the Department of Defense, from Apple, and more. We're going to be joined in just a few minutes by Gracelyn Baskren over at CSIS on the latest.
We're also going to get United earnings after the bell, so investors will really look at the financial impact of flight delays and all the cancellations on the Newark airport that happened. That's really a big headache for a lot of passengers.
Also, speaking of flying, we're going to head out to Pittsburgh's airport. It's undergoing quite the transformation. We got the CEO of the agency that oversees development on how the region is aiming to connect the world to Pittsburgh. All that and more coming up over the next 2 hours right here on Bloomberg Business Week Daily. First up, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much. UAL ahead of earnings after the bell, trading higher now, up by 2.4%. The Dow, the S&P, NASDAQ, and yes, the NASDAQ 100 index, all in the green right now. What a day, what a morning, and this is precisely why you keep it locked into Bloomberg Radio. Speculation about the fate of Fed Chair Jay Powell set off a short-lived tempest in financial markets this morning. Volatility mostly quelled after President Trump said he has no plans to fire the central bank chief and was only discussing it, quote, in concept. Right to the numbers. S&P now up 18, up 0.3%. The Dow up 193, up 0.4. The Dow, as I mentioned, higher. We've got NASDAQ up 0.2%. 10-year, 4.45%. The 2-year, 3.88%. 30-year, 5.01%. Gold, spot gold, 33.48 the ounce, up 0.7%. West Texas Intermediate crude up 0.2%. 66.67 per barrel of WTI. Bank earnings, Goldman Sachs higher by 0.6%. Morgan Stanley down 1.8%. Bank of America down 0.3%. Bank of America traders posted a record second quarter as the company reaped the benefits of volatile markets and net interest income, topped analyst estimates. Brian Moynihan is Bank of America's CEO, and he was on Bloomberg Radio moments ago talking about the quarter.
This quarter was the trickiest quarter to get through because year over year, we finally got some NII growth, but year over year, the markets business doing strong, so expense growth was a little more robust. That'll get in line, and then you'll see NII drop to the bottom line, and it will set up for 2026 with even more growth.
Brian Moynihan of Bank of America. Again, Bank of America shares down 0.3%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thanks, Charlie. So, Tim, we're now halfway through the year, and a lot of uncertainties that loomed earlier haven't really gone away. Markets initially cheered the idea that, tariffs may not be severe as feared, but that optimism is starting to fade, and we're starting to see the first signs of inflationary impact. So, for instance, this week's CPI is one example of that warning. So, bond markets are responding, longer-dated yields are beginning to climb. And with us to make sense of all of those market moves is Simeon Hyman. He's global investment strategist and head of investment strategy at ProShares. That's an ETF issuer that manages some $85 billion in assets. So not really that much. I'm kidding. It's a lot. So thank you, Simeon. Before anything, we really have to start with a story of the day, and that is Jerome Powell, the fate of the Fed chair. As a strategist, how do you make sense of all of this? Are these real so-called threats, or are they just noise?
Well, thanks for having me. And what I find very interesting about this is I think that the president is making the same mistake that a lot of investors do. And what do I mean by that? The focus on the Fed funds rate. In the absence of quantitative easing, the Fed only controls the overnight lending rate. Longer-term yields are determined by market forces. we can park quantitative easing, the thing that happened in the great financial crisis and in the pandemic. But in the absence of that, what history shows is that if the Fed cuts, that usually is a steepener because it's stimulating the economy, and the long end usually sells off a little bit. So it's almost a misguided focus, because if you get what you wish for, that's not going to bring down longer term rates. They're driven primarily by inflation, which we see benign reading this morning, but still overall ticking up just a little bit, and the long end has been selling off for a couple months.
So ironically, the best way to bring rates down would be to bring inflation under control.
Correct. I mean, that's really the only way of long term is to keep them in check.
This is macroeconomics 101 that
it's
we're talking
101,
about here.
and the numbers are pretty clear.
Yeah.
The real rate on the above inflation for the 10-year Treasury historically is somewhere around 2.5%. So if we really got to 2, then you're talking 4.5, which is where we are. But if we end up sitting around 2.5, 3, that's where you can have that 5 handle.
So if the real way to bring rates down is to get inflation under control, how do you view the new tariff regime?
Well, that's the risk. And I think part of the tariff story is euphoria around the acknowledgement that it's not going to be as bad as it looked like on Liberation Day. But as you noted, the euphoria is wearing out, because if we end up with 10 or 15% across the board, that's still a lot more than the 3 we had prior to this administration. So the reality that even whatever tariffs come out will be higher than before, that's absolutely inflationary.
When you think of historical examples when it comes to political pressures on the Fed, how did markets react? I'm thinking maybe Arthur Burns or Nixon, or maybe this time is different because, I mean, we are in 2025 and the president is different from the previous presidents. What do you make of that?
No, it's not good. I mean, you know, that's what we had in the 70s. We had stagflation because there was a lot of political pressure on the Fed, and it took Paul Volcker to clean it up. So the market will embrace the continued independence of the Fed for sure.
And to the point of many sources, like the chair does not make unilateral decisions on interest rate. Like if President Donald Trump replaces Powell, whoever the Fed chair will be, that person's decision may be still overturned. So it's really interesting. But this is clearly a political move, some would say.
It's just back to the first principles. If someone goes in there and they ease too quickly and inflation expectations rise, longer term interest rates will go up.
Is all this a distraction in your view?
I think it's a distraction because the odds are that, as we heard, Powell's not going to be fired and the Fed will probably not be early. The odds are that'll act, if anything, they err on being on a little bit on the late side. So the status quo of the error being on the late side and having the economy get a little too deep in recession before their cuts is still the most likely scenario.
What are the legal institutional limits of a U.S. president's ability to really just remove the Fed chair? And how might this add to the ongoing uncertainty in markets? I feel like every day the list just grows longer and longer.
What we've heard over the last few months is that compared to the heads of other agencies, it appears that the Federal Reserve Chair is more protected from most presidential actions than some of the other heads of agencies that are not even with us anymore. So I think there's definitely more, more protections in place, but none of them are impenetrable, as we found out over the last few months in many instances.
Still over the last few months, since the post-April 2nd bottom of at least the markets this cycle, we've seen a sustained rally higher in equities, despite the fact that I think for a lot of people would argue we don't really have certainty when it comes to tariff policy. Is the market taking the threat of tariffs going into full effect August 1st seriously right now?
There's a little bit of the euphoria that I just spoke about. In other words, since it's not as bad as the stuff from the lawn on April 2nd, there was such a relief rally, and that might have gone a little bit too far. But I think that's not the only reason that the market has rallied so strongly since roughly April 8th. And, that is the fact that fundamentals are so strong. Whether you look at the S&P 500 or the NASDAQ 100, compared to 20 years ago, return on assets stronger, profit margins stronger. Everything is there in spades. And by the way, the NASDAQ 100 was at 30 times then as well. So there is quality support there. The quality of earnings, the cash flow that is generated per dollar of earnings is much better than it was just a generation ago.
Moving forward from today's really huge whiplash of a news, what do you make of the inflation story, especially in light of the big, beautiful bill? Does the Fed have enough reason to ease?
I don't think they can ease that quickly in the face of the big, beautiful bill, because that's clearly expansionary and it adds to the deficit. And I'm not taking any sort of scary point of view here that we're going to have a real deficit problem, but mildly inflationary for sure.
And how about dollar weakness? How is this affecting your general views or your asset allocation? How much of a tailwind is it or not a tailwind?
I think the dollar weakness, combine that with the possible for a little bit of a sell-off further on the long end of the curve, those are related phenomena because both of them related to inflation pressures in the U.S. and a little bit of the growing deficit tarnishing the safe haven. So you absolutely do want some other sources of diversification. Think about it this way. If you look at bonds traditionally the offset to equity risk, but that doesn't always work. It didn't work Liberation Day. Remember, we had the de-dollarization thing and bonds sold off with stocks. And of course, the wound in everybody's psyche is from 2022. The equity market went down 20%. Long treasuries went down 30 in 2022. So we can't quite count on either bonds or the dollar for either perfect stability or diversification. You got to look elsewhere.
Where do you look?
A couple of ideas that we think are important. First, this is a particularly strong environment for cryptocurrency. We know that the regulatory environment has improved a little bit, but we also
improved a little bit. I mean, it's like a sea change.
We're waiting, and it looks good. I don't do the political beat, but the odds are something's going to happen, and it doesn't have to be perfect.
Well,
right?
Markets are the crypto markets.
The crypto markets believe that, and again, the view of the leading voices there are the regulation doesn't have to be perfect. Just give us something that's reasonable. We'll know what to do.
Okay, whenever somebody is on our air and says cryptocurrency, I always get pushback online because people say Bitcoin, not all crypto is Bitcoin. Bitcoin is not all crypto. So when you say cryptocurrency as an option out there, what specifically are you talking about?
Well, you can go beyond Bitcoin, and Ether is certainly a reasonable opportunity. And then you have a couple of sister guys. You have Solana, which is more in the Ether camp, and then you have XRP as an example with the fixed supply that's more in the Bitcoin camp. So I think there's an opportunity there to be a little bit more diversified. And I think the mistake some folks make in the crypto landscape is they think that, well, it's just a risk asset, like everything. It's just going up with the equity rally. But remember 3 years ago when the crypto-related banks were, Bitcoin went up.
Yeah,
it really can be a diversifier. So I think that's one place.
You don't think that it's has too short of a history to call it a diversifier? It emerged after the financial crisis. We don't have that long of a history to look at to say that.
And the fact that it changes its behavior from haven to risk assets, depending on its mood, it seems.
This is so intertwined with all the disruptions that are going on right now, and you have to, I would suggest, walk and chew gum. It's almost inseparable from AI in the sense that there's a lot of disruption going on at once. And to ignore it, I think, is at one's own peril. It doesn't mean that you dive in and hold your nose and just go to the bottom of the ocean. But think about, in the equity markets as well, think about the AI disruption. Way back when, in the late 90s, there was this book called The Innovator's Dilemma.
Yeah.
And it said that the thesis of The Innovator's Dilemma was that incumbent companies cannot take advantage of technological innovation because it screws up their cash cows.
Clayton Christensen of Harvard Business School, a legend who just passed away a few years ago.
I didn't even realize that. Now, today, we got a lot of incumbents who appear to be making a ton of coin off of this disruptive technology, which is entirely different than that thesis. But there are still some disruptors too. So we have this environment where I think you have to at least participate in the disruption, but still, have a lot of the legacy companies and, of course, legacy diversifiers. It's not that you don't want bonds, but you don't know that they're going to diversify you. And cryptocurrency and the blockchain is a real thing that's not going anywhere.
Simeon, thanks for joining us. Come back again soon.
Thanks for having me.
Really good to see you. Simeon Hyman, Global Investment Strategist, Head of Investment Strategy at the ETF issuer ProShares, joining us here in the Bloomberg Interactive Brokers studio. I want to get back to our coverage of Fed Chair Jay Powell and everything happening out of Washington, D.C. The president is actually making comments right now. We'll bring you his comments if he does start to make comments about Fed Chair Jay Powell. Just a reminder, the president denied he's seeking to remove Fed Chair Jay Powell, this after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media. I want to bring in somebody who has quite a bit of experience with the Federal Reserve, former director of the National Economic Council, former vice chair of the Federal Reserve, distinguished fellow at the Georgetown Soros Center for Financial Markets and Policy. Lael Brainerd is with us right now. It's good to have you with us this afternoon, and that's exactly where I want to start. We spoke to Mike McKee out in Victor, Idaho, and he said there was a collective eye roll when he saw the news earlier this morning from the other members of the Federal Reserve and Fed watchers out there. Do you look at the news that we got this morning, the comments from the president that we got this morning, as being different than other criticism of Jay Powell in the past?
I think there's a lot of continuity. He has clearly been very frustrated for some period of time with the Federal Reserve and their wait-and-see mode while they wait to see how tariffs are going to affect inflation and the economy. And, you know, he's very impatient to see rates come down. So I saw those comments today as being certainly in that same spirit, although, of course, the rumors early in the day had more urgency to them. Of course, subsequent to that, he seems to have pulled back those comments, and that's a good thing. I think it would be extremely bad for the United States to have a big rupture in the institutional independence of the Federal Reserve, which is what that would amount to.
Exactly. So how do you think this will affect the Fed's credibility in controlling inflation? And more broadly, how will this political move really just affect inflation expectations? We saw markets react earlier. There was really a huge whiplash from the equity market to the fixed income market.
Absolutely. So if the President of the United States were to go ahead and actually make an effort to remove the chair of the Federal Reserve, that would fly in the face of decades of institutional convention that puts the Federal Reserve in an independent position to pursue the control of inflation as well as keeping labor markets strong. And I think it would really raise important questions in the minds of investors in the United States and around the world as to whether the institutional environment that really underpins the value of Treasury securities, the strength of the dollar, and the expectation that inflation will remain low and stable in the United States, all of those things, I think, would be thrown into question. And that should lead investors to demand more to hold long-term Treasury. So that should lead to the long end of the curve going up.
Whenever the Fed chair gives a press conference, he's asked by journalists about the criticism that the president has made or is making about him. You've worked with Jay Powell for years. You know him. In your view, how does he feel about being this punching bag?
So I don't know how he feels personally, but I know that anybody in that position would feel that they have an important, institutional responsibility. That he was confirmed by the U.S. Senate, that there is a legal set of expectations regarding the Federal Reserve Chair's role. And of course, monetary policy is set by a committee. It's not set by the chair alone. And so it is the Federal Open Markets Committee that has continue to hold on rates. So it's a much broader institutional environment, and personalizing it by this relentless focus on the chair, I think, is extremely problematic. Again, bad for the United States, and ultimately defeats the purpose that I think the president is trying to achieve, which is to see rates go down sustainably in an environment of growth and low inflation.
When you look at the history of political pressure exerted upon the Fed, how do you make sense of today? I'm thinking Nixon, Arthur Burns. Is today worse? Is today different? Or are they more or less the same?
So I think that the past episodes where we've seen a lot of pressure on the Federal Reserve chair to lower interest rates for political reasons have ended extremely badly. And we've seen in those episodes high inflation, and the Fed has really struggled to bring inflation back down. So I think this is a kind of similar set of pressures to what some Fed chairs have felt in the past, but not in the recent past. I think in the, during the period that we have seen low and stable, what they call the great moderation, low and stable inflation, there has been a real understanding that the president, the administration should allow the Federal Reserve to conduct monetary policy in a way that establishes their credibility on inflation control. So this is a big change relative to the last 3 decades, and it's highly problematic. The president has said very explicitly that he wants to see the Federal Reserve lower rates because every percentage point that rates come down, this is what he says, it will save him $300 billion in interest payments on the national debt. And of course, that's more important than ever now that we've just added through the mega law another $4 trillion to the national debt. And so when you hear the president talking about this, he really seems to be very focused on those interest payments. And that is exactly the kind of institutional environment that would undermine the credibility of the Federal Reserve in fighting inflation and could actually lead investors to demand higher interest rates on long-term treasuries.
That's the great irony in this whole situation here. We have 20 seconds left. I just want you to make a prediction. Do you think Fed Chair Jay Powell will fulfill his term as the chairman of the Federal Reserve until May of next year?
I certainly hope so, and yes, I do.
All right. Lael Brainerd, thank you so much for joining us on Bloomberg Business Week Daily. That is, of course, Lael Brainerd, former National Economic Council Director, former Vice Chair of the Federal Reserve, Distinguished Fellow at the Georgetown Soros Center for Financial Markets and Policy. Let's head on over to Charlie Pellet for an update on how markets are doing, because we are just about a half hour until the close, Charlie.
Indeed, and trading at just about the best level of the day, Tim, with the Dow, the S&P, NASDAQ solidly in the green. What a day it has been for U.S. financial markets. You know the story. You were listening to Bloomberg Radio all day long. All of this coming down shortly before 11 a.m. Wall Street time today. Stocks sold off as President Trump initially announced that he was thinking about firing Fed Chair Jay Powell, but speculation that continued and stocks rebounded. We did see a short-lived tempest in financial markets. Volatility, however, mostly quelled after President Trump said he has no plans to fire the central bank chief. Nash, we did have Lael Brainerd, formerly of the National Economic Council, on Bloomberg Bloomberg Business Week Daily moments ago, and here's what she had to say about the entire controversy.
It's a much broader institutional environment, and personalizing it by this relentless focus on the chair, I think, is extremely problematic. Again, bad for the United States, and ultimately defeats the purpose that I think the president is trying to achieve, which is to see rates go down sustainably in an environment of growth and low inflation.
Former Fed Vice Chair Lael Brainerd interviewed moments ago right here on Bloomberg Business Week Daily. Stocks higher, S&P up 18 right now, 30 minutes to go before that closing bell on Wall Street, up 0.3%. The Dow up 0.5 right now, NASDAQ up 0.2. The 10-year yield 4.45%, but the 2-year 3.88%. Gold up 0.7%, 33.47 the ounce. Crude little changed on the day, 66.51 a barrel. Keep it locked into Bloomberg Radio for the latest on any and all developments involving Fed Chair Jay Powell. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thanks for that update, Charlie. We're taking a break from the coverage of the Federal Reserve and talking about rare earths because they are getting a lot of attention right now. Just today, we learned that Canada's Ucore Rare Metals aims to start producing rare earth elements at a new location, a Louisiana facility, next May. It boosts U.S. processing capacity in an industry that's currently dominated by China. For all things rare earths, we bring back Dr. Gracelyn Bascarin. She's director of the Critical Minerals Security Program at the Center for Strategic and International Studies. She joins us from the Bloomberg Toronto. She joins us from Toronto. I know you've been on a lot of planes in the last few days. So we appreciate you joining us from where in the world is Gracelyn Bascarin. I want to know, because we haven't spoken to you in a few weeks, and since then we've gotten a lot of announcements, including from MP Materials, from Apple, this latest from Canada's Ucore Rare Metals. Is the U.S. on its way to relying less on China for rare earths?
The U.S. is well on its way. In the last 2 months, we've seen astronomical progress from a point that U.S. automotive manufacturer came to a screeching halt, and we were virtually begging China to give us some rare earths, both in Geneva and London, to at a point now where the U.S. government is the biggest owner in an unprecedented move of the biggest rare earths company here in the United States. We have a price floor that's close to double current prices that the government has committed to paying. We're building new permanent magnet manufacturing facilities. This is really a story that when the U.S. sets its mind to something, it can do it, and it can do it quickly.
Well, on that, we spoke to James Litinsky last week of MP Materials. It's the day the company struck this multi-billion-dollar public-private deal with the U.S. Department of Defense to build this new magnet plant, expand rare earth capabilities. It's backed by $400 million in equity and a $1 billion loan commitment. Here's what he said about that deal.
The government wants to achieve an important national security objective, and we at MP are able to help them achieve that objective. And so they are going to help support us in accelerating investment in our space, and they're going to create the conditions that allow us to invest with a fair return on capital and not be attacked, so to speak, by mercantilism. And in exchange for that, they're going to expect some upside. And so again, I think this is, hopefully it's a new model that we can utilize across some of these verticals that are really challenging for us, where we've been unable to fully reshore industries because we're facing competition that is thinking differently.
That's James Litinsky of MP Materials just last week on our program. The Department of Defense, Gracelyn, is positioned to become the company's largest shareholder. What is your view on this? Is this what's needed to boost critical minerals and rare earths in the U.S.?
There's two important things to consider about this equity. The first is that it will bring in a return to the American taxpayer, and it already is. When share price is increased, that means that the U.S. taxpayer is getting a return on that investment. That's a big deal. The second thing that's important is there is no bigger signal to the private sector than having government ownership. So as the government went in for equity, we saw companies like JP Morgan and Goldman Sachs also come to the table with a significant amount of capital. Because where there is a project challenge or a hiccup, it's more likely to get resolved when it's part owned by the government. So this is a really powerful step in terms of mobilizing private capital, but also in terms of creating a more financially sustainable model that will yield a return, both in terms of actual security of minerals and magnets, but also a return on the investment.
So we know that Apple made a strategic commitment to MP, and we also know that the Department of Defense also did the same. How does those two alter the geopolitical landscape of rare earth supply chains, and will it prompt other countries or other tech defense players to follow suit?
Apple's move to invest into MP really signifies how executives are relooking at the supply chain. There was a time not too long ago where we thought about minerals, we thought about processing, and then manufacturing. But now we're starting to look at it as a vertically integrated mine to manufactured goods supply chain, because a disruption at any point in that supply chain stops it. Now, for a company like Apple, this is really important. When we started talking about tariffs, the beginning of the year, and two, potential, rare earth disruptions, we started looking at what the cost of an iPhone could increase to. An iPhone is an incredibly price-sensitive good. The average American consumer can't easily go from paying $1,000 a phone to $1,400 a phone if those rare earths become more expensive or more difficult to access. So for a company like Apple, ensuring that there is that reliability of supply is really critical. It also makes sure that it is an American supply chain, which is really important for this administration.
Gracelyn Bascarin, thanks for taking the time. Know you've been running from airport to office, so really appreciate you joining us. Director of Critical Mineral Security at the Strategic and International Studies.
It's 3:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow, the S&P, NASDAQ all in the green. What a day, a volatile session. Let's head right over to the first word breaking news desk for today's afternoon call. Here she is, Jordan Fitzgerald.
Thanks, Charlie. The main U.S. averages are well off their lows after Trump said he would not be firing Jerome Powell. The S&P cash is up 0.3%, with the NASDAQ up 0.1%. Taking a look at the Dow, Johnson & Johnson, Amgen, and Caterpillar lead, with Amazon, IBM, and Walmart under pressure. Johnson & Johnson and Goldman Sachs are strong after earnings this morning, with Bank of America and Morgan Stanley in the red. Regarding trade, Trump said he'll send tariff letters to over 150 nations, and the Fed's beige book showed an uptick in economic activity. Wrapping things up, gold gains with oil little changed, and United Airlines and Kinder Morgan will be reporting after the bell. My name is Jordan Fitzgerald from the First Word Breaking News Desk. All yours.
All right, I thank you very much, Jordan. And for on-demand news, 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive.
It's the question that drives us.
This is the drive to the close.
The funky music will drive us till the dawn.
On Bloomberg Radio.
Well, look at that, everybody. Less than 20 minutes to go until the close of equity trading here. I'm Tim Stenovec, and that is Isabel Lee. She's from the Bloomberg News cross-asset team. She's in for Carol Massar today. You're coming back too, right?
On Friday.
Okay, coming back on Friday. Maybe that's why everybody thinks today is Friday, because they're
I wish.
seeing you here. You wish. Well, we're pretty much halfway through the week. I do want to bring in our drive to the close guest. We got back with us Brian Jacobson, chief economist at Annex Wealth Management. They've got about $7 billion in assets under management. He joins us from Brookfield, Wisconsin. Brian, before today, typically we'd talk about the markets and the market reaction to, I don't know, economic data, inflation data that we got, what's going on with earnings. But we got to start with what's happening at the Federal Reserve, or maybe what's not happening at the Federal Reserve. The reports this morning that the White House is now denying that the president will fire Jay Powell imminently. What's your view on what that would do to markets?
Yeah, well, he's denying it, but maybe that'll change, right? You never know. Perhaps we'll hear a Truth Social post at some weird hour saying that he has changed his mind on that. A lot of it will likely depend upon this whole controversy around the building of the new headquarters for the Federal Reserve. But in terms of the market reaction, I think that it's somewhat notable that we didn't see a bigger downward move in the markets. And I think that's mostly because it's recognized that even if President Trump attempts to fire Chair Powell, that's no guarantee that that will actually go through. I'm pretty sure that the Federal Reserve would marshal a lot of its resources in order to defend the chair. And when it comes to setting actual monetary policy, that's done by the Federal Open Market Committee. And it's a committee decision, so 12 individuals. The chair is a very important individual, but the chair doesn't dictate exactly what the committee will do. It wouldn't be surprising because there is no real legal reason why the chair of the committee needs to be the chair of the board, that maybe they decide that they would want to huddle around Powell and defend him. So I think that's a reason why the markets didn't react more negatively to the original headline, which was that Powell's demise was imminent.
You just hit on this a little bit, but I want you to expand on it. The defense mechanisms, in your view, that you think the Federal Reserve has. Well, what are those?
Sure. So I think legally they could challenge it, right? And so as far as that would be a major thing in terms of get an emergency order to put a stay on it just because of how disruptive it might be. So I think that'd be step one. Step two is that the Federal Open Market Committee itself, they set their own internal rules as far as who is chair, how do they operate. And so perhaps they would decide that we're going to keep Powell on. Nothing says that they need to have the Federal Reserve Board chair be the same as the chair of the committee. And then, of course, the committee itself consists of 12 individuals who are very strongly opinionated. And as we know, based upon all the testimonies or the different speeches that have been provided, the dot plot, if you get rid of the chair, make the chair more dovish, you only really have Waller and Bowman who would be supporting a more imminent rate cut. So that still leaves you with 4 more people that you'd have to get to agree to a rate cut to get a majority rule. So I think that it's almost like you go through that chain of probabilities, and it seems like it's pretty unlikely that policy would be changing anytime soon.
How might markets price in increased political risk or Fed interference, particularly in the bond market or maybe the dollar?
Yeah, well, it was interesting to see how it is that yields did move lower, saying that maybe this does tilt things a little bit more towards the idea that they could cut or that they would need to cut. If you suddenly see an increase in financial stresses, perhaps that makes a stronger argument in terms of the effects on growth, that the Fed would be in a position where they would feel like they would actually have to cut. But in terms of the political risk premium in general, in the bond market, in the stock market, it's typically something that you see in emerging markets, right? That's one of the reasons why emerging markets, you oftentimes see that their yields are higher than in the United States, and their valuations based on price to earnings ratios and such are typically lower, is because of that political risk premium. And I think that we do have that somewhat in the United States, but if anything, it's almost indiscernible when you kind of look at the longer arc of some of these valuation measures, whether it's term premia in the bond market or in terms of the normal price to earnings ratio in the equity market. It matters, but it's more on the margins.
Well, speaking of on the margins versus what's actually the focus right now, I want to talk a little bit about tariffs and the way that inflation hasn't necessarily creeped in the way that many observers 3 months ago thought that it would. Why is tariff-driven inflation not rearing its ugly head right now?
Yeah, I think part of it is because we do have lots of almost kind of springs in the suspension of the economy that can absorb some of these shocks. Consumer prices, you would expect that those would start to react, and we saw that in the consumer price index in terms of, you look at apparel costs, toys, appliances. So those are showing some signs of inflation, but not all of it. And that's because, if you think about businesses, they can't just pass on 100% of their cost increases to consumers. They can't do it immediately, and they can't do it all at once. So margins are likely to take the brunt of the tariff hit. Now, the question is this going to be for the exporters in China or Brazil or wherever, or is it going to be the importers in the United States whose margins take the hint? That's where the producer price index data that we got this morning is suggesting that, well, those prices aren't necessarily moving up all that much. So maybe some of the tariff hit is being pushed back further along into the supply chain towards the exporters opposed to the importers. So it's going to be spread along that entire supply chain.
Beyond the usual inflation talk and Fed talk and tariff talk and all of those talks, what's one thing you think that's underappreciated, a risk in the U.S. economy right now that a lot of markets or market participants or economists are overlooking?
Well, I think the biggest risk is really in terms of the margin pressure. We are very early in the earnings season, and the extent to which we are going to likely see, there's high expectations going in based on valuations, low expectations if you look at the surveys about what's going to happen with earnings. But if we see some misses on the downside with earnings, and I think especially the margins, because margins are really incredibly high relative to history. Part of that is just because more of the U.S. market is technology than what it had been in the past, so you kind of have to do some of those industry adjustments when you're looking at history. But margins are fairly wide, and I think that there's a real threat to margins where if we do see some of those misses, those are likely to be punished much more than the beats to the upside are going to be rewarded.
Brian, gonna have to leave it there. Thanks for joining us. It's been a while. We're glad you're back. That's Brian Jacobson, chief economist at Annex Wealth Management, $7 billion in assets under management, joining us from Brookfield, Wisconsin. Taking a look at how markets are set to close with about 10 minutes to go to the close of equity trading. Stocks up on the S&P 500, 0.4%. The NASDAQ composite up 0.3%. The Dow up about 0.5 percentage point. Coming up next on Bloomberg Business Week Daily, it is our cross-platform coverage of the market close. It's on TV, radio, YouTube, and on Bloomberg Originals. We're going to count you down to the close. This is Bloomberg Business Week Daily.
This is Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week Daily. I'm Tim Stenovec. That is not Carol Massar. It's Isabel Lee. She is Bloomberg News cross-asset reporter. She joins us here in the Bloomberg Interactive Brokers studio. She's in for Carol Massar today and again on Friday. Guess she's busy tomorrow, so can't join us. But that's okay. During this time, we have the simulcast coming up in just a few minutes. What we like to do is take a look at some of the most read stories on the Bloomberg terminal. A lot of them have to do, no surprise, with Fed Chair Jay Powell and his fate, unclear at this point. A lot of interest around that. Another one, a little more New York-centric, but also very Wall Street-focused, and that has to do with New York City mayoral candidate Zohran Mamdani, who told business leaders that he would begin to discourage the use of the phrase globalize the intifada after being pressed on his views by Pfizer CEO Albert Bourla. This is according to people familiar with the matter. Remember, he's somebody who really surprised a lot of observers by beating Andrew Cuomo in the Democratic mayoral primary last month. And he met yesterday with about 100 business leaders. This is from the Partnership for New York City. It's a 350-member coalition of the city's largest banks and media companies, as well as investment, real estate, and law firms.
I mean, he did say he would discourage use of such language, but when it comes to other concerns, he really reiterated his goals, and he brushed off concerns about higher taxes by saying wealthy New Yorkers would stay put regardless, which is questionable because we have some business leaders and politicians online saying that, no, not really, they will be moving elsewhere. Mamdani also said he'd consider, but wouldn't commit to keeping Police Commissioner Jessica Tisch. So I feel like with Mamdani, yes, he won by a large margin, the primary, but in the business community, it's still mixed. And we have Cuomo saying he'll run.
Yeah, he will run, and so will Eric Adams.
Yes.
As independents. So we'll see what happens during the election. By no means is Mamdani a shoo-in. I would still question the folks who'd say, especially the ones who lead businesses, who say that they would leave, because New York City has a lot to offer when it comes to employees, when it comes to access, certainly when it comes to Wall Street and capital. I think the question that a lot of these business leaders have is, what power does Mamdani have to actually follow through on some of the promises that he made, at least during the primary? Free buses, some city-run grocery stores, at least a pilot with those, raising taxes on the wealthiest New Yorkers, but also raising taxes on businesses. A lot of this has to do with working with Albany, and a mayor of New York only has so much power when it comes to those sorts of things. And of course, when it comes to the MTA as well.
That's absolutely true, which is why I think he's trying to consolidate traditional institutions behind his candidacy. And to our point constantly, what the CEO says is different from what the employees feel. And I feel like this is why he probably really won by a large margin, because he galvanized support from those middle income people, for those who are younger ones who feel like they're really being priced out of the city. I mean, if you're 30 plus and you still have a roommate, that's not fun.
On other subjects, the Queen's Assemblyman, Mamdani, held firm. He reiterated goals. He brushed off concerns about higher taxes by saying wealthy New Yorkers would stay put regardless. You said this, Isabel. The question about, too, he would told attendees that he would examine the New York City Department of Education for waste and duplication, and that he would look into the use of the World Cup as an opportunity to build up city infrastructure. Mamdani has been making efforts to consolidate traditional institutions behind his candidacy ahead of November's mayoral race, which could prove unusually competitive in a heavily blue city where the Democratic nominee has been all but assured of victory in recent elections. Check out this story. It's one of the most read stories on the Bloomberg terminal by a lot of folks on our city team who cover the mayoral election. Mamdani grilled on intifada and taxes by New York City business leaders. Taking a look at equity markets right now, the Dow Jones Industrial Average up about 0.5 percentage point. The S&P 500 up 0.3%. The NASDAQ up 0.3%. I'm typing in CRYP Go on the Bloomberg terminal to look at cryptocurrencies. Bitcoin not at a new record, but still up 2.4%. Ether up a whopping 11% at $3,300. Coming up next, it's our Bloomberg TV team for our cross-platform coverage on radio, TV, YouTube, and Bloomberg Originals. The closing bell starts now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlet Food taking you through to that closing bell with the global simulcast. It starts right now. Tim Stenevec in the radio booth. Isabel Lee in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on what, surprisingly, Tim Stenevec, could be a record-setting day.
It could be. I think surprising given what we heard about the reports this morning about Fed Chair Jay Powell. I think that, you know, any other day, the focus would be like we'd be talking about big bank earnings, maybe United earnings after the bell. But the focus for us for much of the day has been, will he or won't he, when it comes to the president and Jay Powell?
But it's interesting. How much would you put credence on the comment, on the pressures of the comment today? Because we really have a Fed chair who's really just trying to keep his job, but a president who's really trying to test the markets and see the market reaction.
Yeah, and he did test the markets, and then, of course, he denied the report, which allowed equity investors to kind of look past everything and push indexes to the highs of the session right now. So the focus comes back to companies and what they tell us about what they're seeing and how they're positioning themselves amid all this uncertainty.
And so far, I mean, the earnings, I know we're very, very early in the earnings season, but so far, it has been relatively encouraging. No one is really basically basically saying, look, things are going to fall off a cliff. We just had an interview with the CEO of Prologis, the biggest warehouse REIT in the United States, and he did suggest there are some pressures when it comes to tariffs, immigration, and other things, but overall, business is still good, and he still sees consumers still spending. As we get the closing bells here in New York, it is green across the screen here on this Wednesday afternoon. And despite all of the intraday ructions that we saw earlier in the session that took stocks from green into the red, we are firmly back in the green almost across the board. The Dow Jones Industrial Average up 0.5 percentage point on the day. The S&P up 0.3% on the day. The NASDAQ Composite up 0.3% on the day. And the NASDAQ 100 closing out at a record high, up about 0.1% on the day. The Russell 2000, that's going to be your main outperformer on the index basis, up 1% on the day. Now, we are, of course, getting some earnings as well, including from United. That's just crossing the wire right now. Let's get right to it as we see those shares bounce around in the after-hours trade, with the company saying second quarter adjusted EPS coming in at $3.87 a share. That's a beat of about 3 cents. As far as revenue, the company basically does say that the revenue did come in above estimates, with operating revenue at $15.2 billion and passenger revenue at $13.84, though we should point out passenger revenue is a slight miss. The Street was looking for 13.92. The guidance for the third quarter, the current quarter that we're in right now, adjusted EPS 225 to 275. That's the range the company is giving. The high end of that range, 275, is above the average of Street estimates for $2.65 a share.
And we're seeing shares of United kind of bounce around. They were down about 1%, now slightly higher as well. Well, when you look at that guidance, what strikes me is that the full year adjusted EPS of $9 to $11, the midpoint of that is higher than the consensus estimate. But when you look at what they have for this quarter, the third quarter, that is a little bit lighter than what analysts had been anticipating. So perhaps things getting pushed out to the fourth quarter rather than seeing any kind of blue skies immediately.
Some really interesting commentary in the press release. The company saying that beginning in early July, United has seen a sequential 6-point acceleration in demand and a double-digit acceleration in business demand versus the second quarter. The airline attributes this to less geopolitical and macroeconomic uncertainty and has updated its full-year adjusted diluted EPS guidance to $9 to $11, underscoring the resilience of United's brand-loyal, revenue-diverse business model. The company also said that in June, United at Newark, and this was a big question given the challenges that Newark had, they said they led all other major airlines in on-time performance and lowest seat cancellation rate at all New York City area airports.
I'm curious to know, are airline valuations attractive at current price multiples, or are some carriers better positioned, like Alaska or legacy carriers like United? And how are airlines managing non-fuel costs, like labor, maintenance, loyalty programs, which we all love? And lastly, I mean, is technology, especially AI, really helping?
Yeah, these are all good questions, and these are all things that strategically investors will want answers to. But in the immediate here and now, the focus is going to be on the fact that this full-year adjusted EPS is a lowered range than what it had previously seen, $9 to $11, whereas previously it expected $11.50 to $13.50. So again, keeping an eye on those shares. As for the trade today on Wednesday, it was a really interesting day because the S&P 500 was bouncing around, but in the last 2 or 3 hours, we saw a steady rise higher. And by the end of the day, look at the IMAP. You only have 3 sectors in the red. Energy stocks down about 0.8%, and communication services and consumer discretionary, basically little changed. Healthcare, REITs, and financials were your top gainers on the day.
All right, I had quite a few gainers to choose from. I want to start with Johnson & Johnson, one of the best performing stocks in the S&P 500. The company beat sales expectations and raised its full-year outlook. It showed confidence even as the pharmaceutical industry faces threats of tariffs and a crackdown on drug pricing. Shares higher today by about 6.2%. The company increased the midpoint of its 2025 revenue projection. It raised the midpoint of its full-year adjusted earnings outlook. Sales in the quarter reached $23.7 billion. That was ahead of the average estimate from analysts. Also, watching what happened with asset management stocks today. In general, they moved higher, including Apollo Global Management. The Trump administration finalized an executive order that would pave the way for 401k retirement savings plans to invest in private equity. This, according to people familiar with the matter. Shares of Apollo, ticker APO, up 4.8% today. And finally, quantum computing stock, Rigetti Computing. It's typically among the most actively traded stocks, but even for a stock that's actively traded regularly, this was a day of outperformance. Shares surged today more than 30%. This after the company said in a press release that it succeeded in demonstrating the largest multi-chip quantum computer in the industry. This milestone is a 2x reduction in the median 2-qubit gate error rate from previous best results in its 84-qubit single-chip Anka 3 system. I don't know exactly what that means, but investors were pretty excited about it.
Let's not have
I was going to have you translate it for me, Romain. I know you're like big into these quantum stocks.
Yeah, I am actually.
I know.
Okay, so now it's time for decliners. We have Ford down by 2.5%. The car maker says it is recalling almost 700,000 vehicles to address a long-running issue over cracking in an auto part that can leak fuel into the engine and cause fire. So the action applies to a certain Bronco Sport and Escape models from 2020 to 2024. Next, we have Bank of America. Ticker is BAC. Shares are kind of flat, but down by 0.2%. So the stock edged between gains and losses, but ended in the red. We have the bank reporting trading revenue that beat analyst estimates, but we have Evercore saying that the result was largely in line and not overly exciting, with trading revenue better than expected and tax rate lower than expected. And last, we have Amazon. So lots of headline for this stock. It's down by 1.5%. Amazon carbon emissions rose for the first time in 3 years in 2024. We have environmental watchdogs really watching this key metric. CrowdStrike also expanded its collaboration with AWS. And lastly, the third headline for Amazon, Cantor Fitzgerald raising their target on Amazon to $260 from $240.
All right, let's check in on yields, because it was a really interesting day. We talk about the idea that a lot of the knee-jerk reaction to some of those headlines on Powell's did get reversed. Not necessarily so when it comes to the Treasury market. You did see yields go down across the board, but what is interesting, you actually saw the yield curve steepen for a fourth straight session. And it's a significant steepening as well, because you talk about this idea here that with a lot of this now weighted back towards the front end of the curve, what exactly are investors pricing in? They may not be fearful of Powell being removed prior to his May 2026 term ending, but they are concerned about how the political pressure might influence the decisions going forward and the decisions after, and what that might mean for inflation.
Okay, you're talking about the bond market and Jay Powell. I'm talking video games here and GameStop. Did you guys see what GameStop ended up doing, given there were some problems with the new Nintendo Switch 2?
Yeah, I saw this. So, so some knucklehead decided that he was just going to staple the receipts like directly onto the box.
Yeah, and what it ended up doing was puncturing the screen. Right. And because this is 2025 and we live in a world of social media.
Did he not know that there was an expensive device inside that box?
Well, not all is lost here.
Okay.
What ended up happening was they ended up auctioning this off. GameStop did.
Wonderful.
$250,000 on eBay compared to a new one, which would cost just $500. Wow. And yes, creating another viral moment for a company.
Wait, why is a punctured one worth so much?
Maybe because GameStop got involved. Ryan Cohen got involved.
Yeah, but it's not like there's anything beyond that, just because it was in a viral moment.
He said it turned into a collectible, and now it's dubbed
collectible.
Staplegate.
He also said, he tweeted it out. He said, if this reaches 6 figures, I will include my underwear.
Wonderful.
And it did reach 6 figures.
Wow.
Wonderful.
I didn't know how to make a moment.
I wonder, do I want to, never mind.
You can see the punctures there in the screen.
Yeah.
Yeah. You know, it was actually hard to see. It didn't seem like that big of a deal.
You know, I would have just returned it too. When I saw the story, I was like, what? But,
yeah, I really had to struggle hard to see where the staple hit. It's not like it cracked the screen or anything.
You know what? Just put that right next to your, your Bored Ape picture and your the banana taped to the wall and whatever other nonsense that we're spending our money on these days.
That is the world we live in.
You weren't the one who bid on this, Isabel, were you?
We got to go, guys. That's going to do it for our cross-platform coverage.
Speak for Isabel.
Of the market close and of United earnings, which we are continuing with on Bloomberg Radio in just a minute. We'll see you guys tomorrow, same time, same place.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
It is Bloomberg Business Week Daily. I'm Tim Stenivek. That's Isabel Lee, Bloomberg News cross-asset reporter. She's in for Carol Masser on this Wednesday afternoon. I'm looking at shares of United Airlines, down about 2.6% in the after hours. The company did just report its latest results. It refined its profit outlook for this year after travel rebounded from flight disruptions, trade tensions, and fighting in the Middle East conflict. I want to bring in Brooke Sutherland. She's Bloomberg News Boston Bureau Chief. She writes the Bloomberg Industrial Strength newsletter, and she joins us, from Boston this afternoon. We're now seeing shares bounce around a little bit, down about 2.3%, Brooke. The company expects full-year adjusted earnings of $9 to $11 a share, and also expects a third quarter adjusted profit of $2.25 to $2.75 a share. Excuse me. Are there any surprises in here, given that United kind of front ran Delta last week with that regulatory filing?
I think it's notable that they are, last quarter they kind of did that bifurcated guidance. They gave, sort of more of a doom and gloom scenario, and then a more optimistic scenario. And the guidance that they are out with today is lower than that optimistic scenario. And so, they're talking about how they've seen an improvement in demand, particularly in July, but that does still indicate that, this is not going to be as robust of a year for United as what they thought initially in January. And so, it sort of echoes what we did hear from Delta, is that things have stabilized, but they've stabilized at perhaps a lower rate. And you are still seeing that pressure in United on that passenger revenue per available seat mile, which is a really good gauge in terms of profitability and their ability to wring, more revenue out of each passenger on their plane. You are still seeing that pressure there, which has, of course, been something that the entire airline industry has been grappling with, particularly domestically, where we've really seen, a glut of seats, particularly for that leisure customer.
What do you think were the key drivers behind the EPS of United?
I think we'll get more detail on that as we get onto the call. But what we've seen, from a number of airlines is that there was a bit of a pullback, in air travel demand, just as the public dealt with this onslaught of geopolitical and economic news. And that's not just for the leisure traveler, but also for the business traveler. And that took a toll. It's encouraging to hear that United is seeing that demand pick up. That's something that Delta talked about as well, of really starting to see passengers come back. I think the question is, does that last? We saw in the inflation data this week that we are seeing prices rise in some of those categories that are being hardest hit by tariffs. Does all of that start to take a toll, and the consumer pulls back from spending on some of these experiences like air travel? Given that the industry is already struggling with some supply-demand dynamics, I think that's what the concern is.
I was really interested to see in the press release that came out just 12 minutes ago that July is already seeing a marked difference than the company saw in April, May, and June. So if you look at the press release, the company actually says, and I'm just pulling it up here, forgive me, basically says that in early July, they're seeing a positive shift in demand. And like in 2024, they anticipate another inflection in industry supply in mid-August. Do things change that quickly for consumers and for businesses? They said that in early July, they're seeing a sequential 6-point acceleration in demand and a double-digit acceleration in business demand versus the second quarter, and they attribute this to less geopolitical and macroeconomic uncertainty. Does that type of consumer sentiment change that quickly?
It can, and I think that's why, when you saw the series of warnings from airlines earlier this year, particularly Southwest, talking about that really dramatic drop-off in booking demand, it really spooked investors, because this does tend to be an industry that's sort of on the front lines of those sentiment shifts. And so it can move rather quickly as people make decisions on purchasing tickets based on sort of how they feel about how the economy is going. And I think it's interesting, because I think a lot of investors would tell you that nothing is stable right now in terms of the trade environment. I mean, we're getting new headlines basically every single day about tariffs and what that dynamic looks like. But there's a little bit of fatigue, perhaps, with that, a little bit of settling in of this is the new reality right now, of a lot of chaotic back and forth as far as tariffs are concerned. And maybe that's giving people the confidence to say, well, this is going to be happening for a while, this sort of chaotic back and forth, and I need to make decisions now in terms of what kind of travel I'm going to book.
We have several analysts cautioning that the sector is missing 2024's boost from strong comps and fuel tailwinds. Does that mean upside could be limited in the second half of the year for this year?
It could, without sort of another leg to growth. And, one of the things that is also interesting that we've seen from the airlines is this really bifurcated growth story. Delta talked about how revenue from its premium cabin was up 5% in the most recent quarter, but in its main cabin, revenue was down by the same amount, which really sort of shows, going back to this K-shaped type of economy where wealthier individuals are able to keep spending money on things like air travel, whereas the lower income consumer does feel more pressure from inflation. And I think it's going to be really interesting to hear what United has to say about that as well. But then as we get further into earnings season and you see some of these airlines that don't have as much exposure to business travelers or international travelers or premium flyers as United and Delta do, that's going to be a really interesting indicator of how the overall consumer is doing, and if we do continue to see those pain points at the lower end of the income spectrum.
So I want to shift gears a little bit just in the last 2 minutes or so that we have with you, Brooke, because you cover industrials, and we are starting to hear from some of the industrial companies and get updates from them. And I'm wondering what you're hearing from them with regard to the strength of the consumer or maybe an uptick when it comes to industrial demand or industrial manufacturing here in the U.S. Are you hearing any of that?
Not so much on the consumer. There's not many industrial companies these days that cater to the consumer anymore. They used to, but we are hearing a lot of comments about sluggishness and stabilization, but stabilization at a lower rate. And so in some ways sort of parallel to what we're hearing from the airlines, but sluggishness keeps coming up a lot. And remember that the manufacturing sector has actually been under pressure for years. And, a lot of investors and companies were really looking for a recovery this year. Now that has not played out because many of these decision makers are really just in a holding pattern. It's really difficult to make purchasing decisions, plant investment decisions, what have you, when you don't know what things cost. And so I think, even though we're seeing industrial reserves generally come in okay, sort of within the range of what people expected, CEOs keep cautioning that, uncertainty is still very persistent. And because of that, demand looks sluggish through the back end of the year.
What about when it comes to tariffs? We know that average tariff rates paid in the period, particularly when it relates to China, ended up lower than what was anticipated. So is this kind of good news for those companies?
It definitely is. And that means that, mathematically, we probably will see guidance increases for manufacturers. You also have the weakening in the U.S. dollar, which is a huge boon to U.S. manufacturers with overseas operations. And so I think just the sheer math of tariffs being lower than what companies expected when they last reported earnings in that sort of April timeframe and the benefits of that weaker U.S. dollar will mean that we do see a lot of guidance increases. Now, the question is, those guidance increases are maybe sort of just technical versus, a sign of a real robust recovery in demand. And I think that's what investors are really going to be looking for. Are there those green shoots? Are there the signs that, people are moving out of this phase of uncertainty and willing to make spending decisions, capital investment decisions, what have you?
Brooke Sutherland, she's Bloomberg News Boston Bureau Chief. She writes the Industrial Strength newsletter. Check it out. It's on the Bloomberg terminal and at bloomberg.com/newsletters. Thanks so much, Brooke. United Airlines shares down right now. They're moving lower in the after hours, down about 3.4%. Hey, speaking of airlines, coming up next, we're going to continue talking air travel. We've got the CEO of the Allegheny County Airport Authority. They oversee the development of the Pittsburgh International Airport, and they are doing a lot of work to revamp that airport. That's next on Bloomberg Business Week Daily.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg Update. We've got United earnings after the close of trading. This Bloomberg Business Flash brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. customers with minimum financial commitment, see if your company qualifies at oracle.com/Bloomberg. United Airlines has refined its profit outlook for this year, expecting full-year adjusted earnings of $9 to $11 a share. United is trading lower after hours, down by roughly 2.5%. The carrier cites a double-digit acceleration in business demand so far this month compared with the second quarter. Just getting word, too, that Sarepta Therapeutics cutting more than a third of its workforce and will add a black box warning label to its gene therapy for a fatal muscle disorder after 2 patient deaths. The Dow, the S&P, NASDAQ all advancing today. S&P 500 index up by 20 points, now back at 62.63, a gain today of just about 0.3%. The Dow up 231, up 0.5%. NASDAQ up 52 today. For NASDAQ, that was a gain of just about 0.3%. 10-year 4.45%, the 2-year 3.88%, the 30-year 5.00%. Spot gold up $24 the ounce, 33.48 up 0.7, and West Texas Intermediate crude up 0.2%, 66.66 a barrel on WTI. Speculation about the fate of Fed Chair Jay Powell set off a short-lived tempest in financial markets earlier today. At one point, we had the S&P falling to 62.01. Yesterday, you recall, it was at 6,300, a record volatility, however, mostly quelled after President Trump said he has no plans to fire the central bank chief. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts, and keep it locked into Bloomberg Radio for the latest developments involving President Trump and Fed Chair Jay Powell. That is a Bloomberg Business Flash.
Hey, thanks so much for that update, Charlie Pellet. Do appreciate it. Redhead crossing the Bloomberg terminal as we speak. President Trump says Coca-Cola has agreed to use cane sugar for Coke in the U.S. This is something that is very interesting in my world, because sometimes I'll go to somewhere and say, after maybe a long bike ride, and find a glass bottled Mexican Coke, and it's much more expensive. It has real sugar. In my opinion, it tastes better. Have you had this?
I haven't had it, but I've heard about this. People say that those in bottles, especially those from Mexico or honestly elsewhere in the country, outside the U.S., taste better. Maybe I'll try it.
Cheers to Coca-Cola, not moving much in the after hours as we speak. Pulling it up on the Bloomberg terminal right now. It's really fractionally, not even moving. Hey, in March, just a few months ago, I was flying from New York City to Pittsburgh. I landed at Pittsburgh's airport. I noticed a couple things. One was that there was a lot of construction going on. The whole thing was under construction. The other thing I noticed was there were signs for British Airways and Iceland Air. And I was thinking to myself, why are British Airways and Iceland Air flying into Pittsburgh?
Iceland is in a lot of people's bucket list, but you're right. You wouldn't think of it in not a major airport.
Well, it wants to be a major airport, and that's exactly why we're bringing in Christina Cassotis, CEO of the Allegheny County Airport Authority. It's the agency that oversees developments at Pittsburgh International Airport and Allegheny County Airport. She joins us this afternoon. Christina, good to have you on the program. You're at the airport right now in Pittsburgh. First, give us an update on construction. When is this going to be done?
Yeah, well, first of all, Tim and Isabel, thank you for having me. We will be done with construction in October when we open to the public, the new terminal.
So how do you think about Pittsburgh's place geographically and as an airport, getting customers outside of the United States to Canada and to Europe? How do you view it as doing that?
So, first of all, you know, we are a medium-sized market in the United States, and we've got a pretty significant global community here with a number of Fortune 500 companies based, and we think that it's critical to get out into the rest of the world and to connect with the rest of the world. So we have a real effort to make sure that we have the right air service to do it. I was listening to you talk about British Airways and Iceland. They've been here. BA was here way back in the days of the hub. And getting them back made a whole lot of sense. And we keep looking for more expansion opportunities for other airlines to serve our global market.
I'm looking at videos and it looks fantastic. And upon doing my research, I also read that your airport is the first major U.S. airport powered by its own natural gas and solar microgrid. So can you talk to us about how these energy initiatives fit into your long-term vision and why did you decide to do this?
Yeah, thank you so much for that question. I think we're the only ones in the world, just to be candid. We decided about 5 years ago, after Atlanta went down for the day and then LAX had a significant disruption in service and had to discontinue operations for a period of time, that since we have the Marcellus Shale, one of the largest natural gas deposits in the U.S., literally under our feet, we actually extract natural gas on site here at the airport, that we should use it to power our own microgrid so that we could have resiliency and redundancy. And if anything like what happened at London Heathrow happened in Pittsburgh, we would be able to go into island mode and completely operate on our own. And that's what's happened. And we've been successful with this for 4 years now.
Does this mean you'll be more isolated when it comes to shortages and outages and all those disruptions that we've been seeing in all major airports around the world?
Yes. So after London, then there were outages in Spain and Portugal. That would not happen here. Not only that, but our microgrid completely powers our airfield, 4 runways, all the taxiway and runway lights, the terminal, our hotel, and our gas station. And one of the things that happened when Spain and Portugal had their outage is that people could not pump gas. Turns out you could do that here if it ever happened, if the grid really had a major failure. So we are energy independent. It allows us to be resilient. It has helped us create site-hardened infrastructure, and it's something we're really proud of and look forward to other airports doing throughout the world, because when one airport goes down, it affects everybody.
You know, I'm interested in the status of Pittsburgh as a hub airport. I think people who remember years ago it was a U.S. Airways hub. I believe many years ago, TWA had some sort of hub at Pittsburgh, but we're talking ancient history here. Are you actively trying to get airlines to make Pittsburgh a hub again?
No.
Why not?
It doesn't. Because it doesn't. The major airlines in the United States have picked their hub markets. They tend to be very large cities. The way that airline economics work, airports are not why airlines serve you as a city. It's because you have a market, and we have a great global market where there's a lot of air traffic, but it doesn't necessarily support a hub airline. Now, do we have a lot of activity at this airport? Yes, but we serve an origin and destination market, so people begin and end their trips here as opposed to connect through. We certainly have the infrastructure for a hub, and if an airline ever wanted to come back, we would be thrilled to have them, and we have the space. But becoming a hub again is not our future necessarily. Becoming a really strong origin and destination airport like Tampa or San Jose or Portland, Oregon, that's a different business model, and we're doing a really good job succeeding at that.
We've heard from airlines that travel demand remains strong, but we have constraints like labor shortages, capacity constraints, and inflation. Those are all ongoing issues. What is your outlook in the next, say, 12 to 18 months for the sector, particularly to mid-sized airports like yours?
Well, I think, first of all, your sources are spot on. You know, there are very, very significant constraints in terms of capacity, in terms of aircraft manufacturers being able to deliver aircraft in a timely manner, engine manufacturers doing the same. There are headwinds in the economy that, a lot of global leaders, including Ed Bastian, have called out, saying that, we've got a notable reduction in a non-recessionary environment. I think that's the language that he used. So what do I think? I think that travel always bounces back. And I have seen travel called DOA so many times in my career, I can't even count. After the Gulf War, after COVID, after 9/11, everybody says, oh, this is it. We're all going to be video conferencing. And travel always comes back stronger. People still want to travel to see loved ones, make business deals, and there's a significant part of the world that hasn't traveled yet. So I think that we will continue to see travel grow despite any short-term impacts due to capacity and or inflationary constraints.
Christina, thanks for joining us. Love talking air travel, love talking airports. I know it is in your DNA, so we really appreciate you joining us. Please do come back soon. That's Christina Cassotis, Chief Executive Officer of the Allegheny County Airport Authority. It's the agency that oversees developments at Pittsburgh International Airport and Allegheny County Airport. I also had a really good hamburger, Isabel, at the Pittsburgh Airport. Yeah.
You have a lot of experience in Pittsburgh.
Well, it was 24 hours, and all I got to do when I was there was go to the airport, go to the hotel, do this shoot, then go back to the airport. So the only meals that I actually got to eat were at the airport.
Okay. Fair,
Sometimes that happens.
Sometimes it does.
Weather here in New York, no easy transition, but the eastern U.S. and New York City are going to sweat through another round of hot and sticky weather that's today and tomorrow. I certainly noticed that on my commute in a forecast that has prompted an emergency alert from the nation's largest power grid. I want to bring in Bloomberg meteorologist Craig Allen. Craig joins us from Long Island this afternoon. Craig, good to have you. What's the weather system that's bringing us this hot and humid weather?
Yeah, thank you, Tim. It's not quite as hot as the one that we had back at the end of June into early July, but it's up there for sure. And I'm taking a look right now at some of the heat advisories and the extreme heat warnings, and they run from the lower Mississippi Valley, about 50 miles either side of the Mississippi River. It goes on up, right up to the Washington, New York City, Boston area too. So right now, this includes lower Virginia, like around Norfolk, just to the east of D.C., over towards Baltimore, Philadelphia, New York City, and all Long Island is in this too. And it even goes up to the central sections of New England. We're talking about a heat advisory that covers most of the middle of New York State, Connecticut, Massachusetts, parts of New Hampshire, as well as Vermont, and even lower sections of Maine. Temperatures there right now are up in the upper 80s to low 90s, even as of now.
Is this heat consistent with historic norms when it comes to Northeast regions?
No, it is not, Isabel. We're talking about temperatures that are running at around 10 degrees or 10 to 15 degrees above average for this time of year. And then there's that old statement that really applies to this particular outbreak of heat once again, and it's the humidity, not just the heat. The heat index is going to be up over 100 in many of the areas that are covered by the heat advisory right now. So somewhere between 95 and 105 is what it's going to feel like for the remainder of today and tomorrow for sure. There might be a little bit of a break, thank goodness, as we get on into Friday in the early part of the upcoming weekend, especially in the east. It'll be pushed aside, maybe tempered a little bit, but then it comes back to some degree by Sunday and Monday into next week. So even though summer was off to a very slow start here in the Northeast, it has definitely come back with a vengeance, and it just keeps repeating itself, and it will be here for a good couple of weeks.
Craig Allen, Bloomberg meteorologist. 93 degrees in New York City tomorrow. This is Bloomberg.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Turned out to be an up day. The Dow, the S&P, NASDAQ, all advancing. That despite a lot of controversy, a lot of financial fireworks right around 11 a.m. Wall Street time. Speculation about the fate of Fed Chair Jay Powell set off a short-lived tempest in financial markets. Volatility, however, mostly quelled after President Trump said he has no plans to fire the central bank chief. The S&P 500 index fell to 62.01. Keep in mind, yesterday it did trade briefly at 6,300, a record. Up today by almost 20 points, up 0.3%. The Dow up 231, up 0.5. NASDAQ today advanced 52 points, up another 0.2%. 10-year at 4.45%. The 2-year 3.89%. The 30-year 5.01%. Gold up $23 the ounce now to $33.47, up 0.7. West Texas Intermediate crude up 0.2%, 66.63 a barrel. And the surge for Bitcoin today up 2.9% to 119,785 on Bitcoin. Brian Jacobson is chief economist at Annex Wealth Management. He was a guest right here on Bloomberg Business Week Daily. He told us he's not sure the Trump-Powell controversy has completely gone away.
He's denying it, but maybe that'll change, right? You never know. Perhaps we'll hear a True Social post at some weird hour saying that he has changed his mind on that. A lot of it will likely depend upon this whole controversy around the building of the new headquarters for the Federal Reserve.
Precisely why you got to keep it locked into Bloomberg Radio for any and all of the latest developments. Brian Jacobson with Annex Wealth Management. So again, recapping here, stocks higher, S&P up 20, a gain there of 0.3%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie Pellet. President Trump denied he's seeking to remove Fed Chair Jay Powell after raising the idea in a closed-door meeting with congressional Republicans that leaked to the media. No, we're not planning on doing anything, Trump told reporters on Wednesday. He later added, I don't rule anything out, but I think it's highly unlikely unless he has to leave for fraud. Molly Smith is economics editor for Bloomberg News. She joins us here in the Bloomberg Interactive Broker Studio. Molly, you walked in and you said, today has been quite the day. And I assume you were referring to the back and forth with the reports early this morning from CBS, from the New York Times, and from Bloomberg, all independent reports, about the president supposedly last night waving around this letter that he'd written up that said he was terminating Jay Powell. Now he's denying it.
Yeah, that's mostly been the chaos I was referring to.
Okay, just making sure.
Yeah, we're on the same page. So it's been a whirlwind of last 12 hours, really, on this, and that it seems like Jay Powell still has his job for now, and that he apparently will have it until, his term is up in May 2026, unless there is a reason to fire Powell before then, which this is what Trump and the Republicans have been seizing on, is looking to what is that for cause that they would have to be able to fire Powell for. There has to be some real reason, which, the legal scholars have defined as some real evidence of malfeasance or really, what have you actually done that's warrants this? And where the party has really seized on is that the Fed has been working on this renovation of its headquarters, and that the costs of it have maybe gone a bit above what they were initially, and that they're saying that maybe this could rise to that level. Granted, now it seems like Trump today talked back a lot that he's going to fire Powell, but it certainly, he kind of left the door, it seems to me, a little bit open as to this, it doesn't sound settled yet to me.
Well, let's listen to what the president has said about Jay Powell over the last few months. Check it out.
And the fake news is saying, oh, if you fired him, it would be so bad. It would be so bad. I don't know why it would be so bad. So we have a stupid person, frankly, at the Fed. I call him Too Late Powell because he's always too late. I know within 3 or 4 people who I'm going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. I'd love him to resign if he wanted to. He's done a lousy job.
Jerome Powell's been very bad for our country. We should have the lowest interest rate on earth, and we don't. He just refuses to do it, and yet he's spending $2.5 billion rebuilding the Fed.
He's a terrible Fed chair. I was surprised he was appointed. We're not planning on doing anything. We're very concerned.
That was President Trump over the last few months. The last clip there, said we're not planning on doing anything. We're very concerned. I was surprised he was appointed. That was from today. I was surprised he was appointed. Mike McKee pointing this out to us.
Appointed by President Trump himself. Let's just remember that.
Exactly, in his
Trump's
first term.
Biden did extend that tenure, but yes, initially appointed by President Trump, yes.
What are your sources telling you? Is this just political theater, or is there really real steam behind this effort?
It definitely seems to be that, I mean, look, Trump has made no secret he wants interest rates lower and that he wants a Fed chair who is going to be, complicit in carrying out that agenda. And it's tough because the chair does not act alone in what ultimately is the course of interest rates. And the other thing that, something we talk about on our team a lot is that, let's say that Powell is allowed to stay on to the end of his term in about a year from now. If everything is still going to plan the way that the Fed projects that it will, and granted, of course, these forecasts are subject to change, the data is always evolving, who the heck knows what's going to happen in a year from now, but assuming it plays out the way that they see it, the Fed is going to be cutting next year anyway. Doesn't matter who the chair is. So it's, it's really just, it would just really create such a messy situation if Powell were to be fired. Powell still has a board position that he could perhaps still be on as a governor. Is there then going to be a shadow Fed chair beyond this term? There's just so many variables here. And then all of these other people who are jockeying as potential candidates to replace him. Again, this is still potentially about a year away from now. This could be a long time that we are having this discussion.
That's exactly the point. The Fed chair is not the lone decision maker. There's a committee that can overturn his or her decision. Can you talk to us more about the board composition? How much of them or how many of them support President Donald Trump, or why is he so insistent on firing Powell?
So there are 19 members of the Fed system between governors and Fed presidents who will rotate through who's on what's called the Federal Open Market Committee. And that's the committee that actually sets interest rates. And that is a rotating committee, has a few staple players, governors are always on it. The New York Fed president is always on it. The chair is always on it. But some of the other regional Fed presidents rotate in and out each year. So what Powell is, he is, as chair, he is also head of the FOMC. Doesn't have to be the same person, but usually is. And the other people on the committee don't have to vote in line with the chair, but it certainly does help when you have, a lot of these unanimous votes to show that there is alignment on the committee. Granted, this is something that has really been something that has been, frankly, a hallmark of Powell's tenure as chair, that there has been a lot of unanimity? God, I'm really getting tripped up on that word.
I'm buying it.
A lot of unanimous decisions, let's say that.
Yes.
Perfect.
Few dissents. That has been the hallmark of Powell's tenure. But we are getting into this really interesting time right now where there is division on the committee as to what the inflation outlook is going to be, as to how tariffs are going to filter through. And that's where you start to wonder, okay, is it going to be this one-time price shock, or is it going to prove more persistent? And that's where the path for policy has been a bit up in question right now.
There are a lot of questions about what's going on with a search for a new Fed chair. Scott Bessent was on Bloomberg Surveillance Tuesday morning and listen to what he said about the search for Trump's replacement.
Well, look, there's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
And by Trump's replacement, I meant Powell's replacement, obviously. Scott Bessent on Surveillance yesterday. Just 45 seconds, Molly. Battle of the Kevins right now? Is that what it is?
It seems like it, yeah. The two top contenders right now seem to be Kevin Hassett, who's leader of the National Economic Council. This is basically one of Trump's top, most longstanding economic aides. And then we have Kevin Warsh, who was a Fed governor coming out of the financial crisis period, and is, once was a really staunch supporter of seen more as a hawkish person, is in favor of keeping higher interest rates, and now seems to be more aligned on the lower interest rate regime. Seems like Hassett right now is the leading contender. He is certainly the most aligned with Trump, but we also then have Chris Waller, who's sitting as a Fed governor right there, a Trump appointee ripe for the taking, and not to mention Scott Bessent himself could also be in the running. So it's crowded, and we still got 10 months to go.
Don't worry. Before that is the U.S. Open.
Oh, thank God.
You can take a little break with that. Molly Smith, she's economics editor for Bloomberg News and our in-house tennis expert. This is Bloomberg Business Week.
listening to Bloomberg Business Week Daily with Carol Massar and Tim Stenovec on Bloomberg Radio.
It is Bloomberg Business Week Daily. That's Bloomberg News cross-asset reporter Isabel Lee. She's in our Bloomberg Interactive Brokers studio. She's in for Carol Massar this afternoon. I like how Charlie Pellet described today's trade. There was a little bit of a tempest.
I know. I want to repeat it, but I don't want to copy Charlie.
That's okay.
He's the best.
I just copied him, and it's fine. But that's really what we saw. You know, this morning we heard the comments, and before we heard the comments, we saw the reporting from Bloomberg, from New York Times, from CBS about Fed Chair Jay Powell. And to me, Isabel, it seemed that this reporting was different. It indicated some sort of imminent ousting of the chair of the Federal Reserve. And then during our 2 o'clock hour, we spoke to Mike McKee, and he said there was collective eye rolling at the Rocky Mountain Economic Symposium because it's more of the same.
That's true. I'm more on your side, but then that's why maybe trading action was just really modest in the grand scheme of things, because a lot of people are saying that this will provide a poor proxy for how markets will react because they're calling Trump's bluff. There's taco. Trump always chickens out. And maybe even when it comes to this, he may taco.
Something also that is worth keeping in mind is the president is really, really good at controlling the narrative. And I'm wondering if we're all paying attention to what's happening when it comes to Fed Chair Jay Powell and the Federal Reserve, and not focusing on other elements when it comes to domestic policy, when it comes to geopolitics, when it comes to other areas of focus in the Republican Party that perhaps he doesn't want attention on. So who knows?
That's definitely a good point. If you type READ GO, that's the most read stories from Bloomberg. To your point, Tim, earlier, it's all Trump and Powell news. And this is really getting a lot of the attention, dominating the headlines. But there are real issues that we should be paying more attention to. Although this is kind of hard because it is the Fed chair, the most powerful central bank on earth.
I'm Tim Stenovec, along with Isabel Lee, Bloomberg News cross-asset reporter. We're joined by another cross-asset reporter, Bloomberg News' Denitsa Sakova. Denitsa's here with Stock Movers. Let's take a look at some stocks on the move today. What do you have your eye on?
Let's start with Johnson & Johnson. The ticker is J&J. That's obviously one of the first healthcare companies reporting this season. And quarterly sales expectations beat, raised its full-year outlook. And the stock jumped more than 6% today. This was its best day since March 2020. This is showing confidence in the pharmaceutical industry. We've been talking about Trump today, but that's one industry that has been in the middle of tariffs, crackdowns on drug pricing. Just as recently as last week, Trump announced that he may impose tariffs as high as 200% on drug companies. Obviously, as we saw today, a lot of those things are moving very fast, and we're yet to see what's happening. But also the White House has threatened to impose a policy that would force drug companies to charge the U.S. government the lowest prices they offer to other wealthy countries. So there are a lot of changes, but clearly what we're seeing from the earnings reports is that investors are shrugging this off. They are very optimistic about the report. J&J is up 14% year to date. Strong second quarter, just really strong earnings report overall, and a good start of the earnings seasons for those companies.
What about Morgan Stanley? Stock traders scored their best second quarter on record. What about that?
That was really fascinating, right? A really strong earnings report. The stock was down. It fell as much as 4.5%, close 1.5% lower. Ticker is MS. Of course, the good news was stock traders scoring their best ever second quarter. This is something we saw for trading revenue across big banks. Obviously, we continue to see big volatility, and that benefits trading. But one reason we're seeing this drop today is the investment banking revenue. It actually beat estimates, but it fell 5% to 1.5 billion. We saw some increase in equity underwriting, but that's definitely putting some pressure. Some people are also saying that bank valuations are getting pretty expensive. That's what we're hearing at Wolf. One reason that potentially we're seeing some pressure on Morgan Stanley. Today, the shares had rallied more than 40% since the April low. So clearly some big rise there. And that's really this earnings season. Banks are not seeing so many big gains, at least today. We're not seeing that crazy euphoric reaction.
That's a great point because some people have been brought up that banks have been viewed in the past as utility, but now maybe they're more growthy and investors are just expecting more and more and more. So maybe that's why stocks haven't really moved, even if earnings have been great. Okay, what's next? I know your next stock is something I'm not too familiar with.
You probably are. It's actually United Natural Foods, which distributes to Whole Foods. So it's a lot of those healthy brands you can think of. It jumped 12%. This was the biggest intraday jump since March. The food distributor providing investors with much anticipated new guidance view. It was much better than feared. But it was very interesting because last time they used to have a cyber attack and outlook was put. The distributor to Whole Foods and other healthy grocery chains said that it now expects revenue of $31.6 billion for the full fiscal year. That's significantly higher than what they previously expected. The adjustment reflects a strong performance for the first 3 fiscal quarters. The cyber attack overshadowed their third quarter results. It actually tumbled 9% on that day when the food distributor declined to update its full-year outlook. But now we're seeing a lot of optimism, including a CFRA analyst, which upgraded the stock to buy from hold. Stock is still down year to date, but massive boost today.
Denitsa Sikova, Bloomberg News cross-asset reporter with today's Stock Movers. For more conversations like this, check out our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Check out Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Isabel Lee, thank you for joining us.
It was fantastic. What a whirlwind.
It was a whirlwind. We'll do it again on Friday. Balance of Power.